Inflation remains well above our longer-run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
I would say we're close, but we still have a bit of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is decision time for the Federal Reserve and Chairman Powell, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene and the wonderful Bramo back in the hot seat. Yes. I'm Jonathan Ferro. Your equity market on the S&P 500 slightly negative this morning. Earnings from Alphabet, the stock higher. Microsoft, the stock lower. Meta coming up a little bit later after the closing bow. TK, before we get there, 2 p.m. Eastern time, it's Chairman Powell and co.
It's Chairman Powell, and I'm going to go to earnings, John. I think you're dead on to talk about Google and Microsoft. And frankly, LVMH, the growthiness is out there. There's this worry, that's that worry, that the backdrop for the Federal Reserve System of the United States of America is a growthiness of America that's been the great missed call of 2023. And you can sum it up you want. Give me 8 worries about this stock, that stock, the other. The fact is the backdrop for this Fed is a vibrant America.
No projections, no forecast from the Federal Reserve today. You'll get a statement and a news conference. Brahma, welcome back. We'll get into the statement. To Tom's point, the growthiness, how they characterize that in the first paragraph of that statement, and what they say about inflation and the improvement we've seen in the last couple of months.
And whether there'll be a dissent from the one and only Raphael Bostic, among others, but how much you're going to get some sort of unanimity among participants that are looking at growthiness in certain aspects, perhaps in the consumer-facing, consumer spending industries, and less so on companies' spending. You saw that with perhaps a little bit of a disappointment with some of the Microsoft earnings, as well as going forward what some of the consumer outlook is in specific sectors.
So back in the middle of June, there was a feeling there was more to come. 1 month, 2 months later, there's a feeling it's one and done. Which one is it, and does that change again in 1 month's time?
This is a great point, and something that I was reading in a lot of the notes, that there's a 44% chance priced into the market of a September rate hike following on to what we're expecting today. This could change in a heartbeat. We've been here before. We've had this this movie play out where people said no more, and then all of a sudden you see housing reaccelerate, you see other areas reaccelerate. And at what point does that lead the Fed to make a very different decision?
Alphabet this morning up by 6.7%. We mentioned the earnings as well. We'll keep an eye on that. Microsoft is down by 3.7% after the close a little bit later. You're going to hear from Meta. Then next week, tomorrow, Amazon, Apple on deck. Here's the state of things right now. Equity futures on the S&P 500, slightly negative on the S&P, just a bit softer to start the day. We're down by 0.1%. Tom, yields basically unchanged. Your 10-year, 3.88 this morning.
I'm glad you mentioned yields, and that, that's, I guess, what you've got to watch here. The 10-year real yield, 1.50%. There's been a churning there as well. I really don't know what the Fed PhDs look at here. I'm going to look at what Drew Mattis said yesterday to us. Bramo was not here. And Bramo, what Drew Mattis said is he models out more long-term a vibrant 3% real GDP. That is an outlier call. How does that change Fed policy out 2 years, out 5 years?
And we get GDP tomorrow, which might give some kind of read on this. Again, though, and this is something that we keep talking about, how do you dovetail the fact that you are seeing a reacceleration at a time, John, when otherwise we're looking at other areas that are falling off, like corporate spending?
Well, beyond corporate spending, think about the split right now, Bramo, between not just the United States, but Europe. Not just Europe, but China. TK and I had this conversation yesterday, and I know it's something you've been thinking about. Germany's in recession. China's throwing stimulus at the issue. And the United States has a very, very different problem in the eyes of the Federal Reserve right now.
And that's, I think, what people are looking at. We're looking at today is this idea of the Federal Reserve meeting, which is going to happen at 2 p.m. After that, we are going to, and before that, we're going to have our special at 1:30 p.m. Bill Dudley will be with us, former New York Fed President Bob Michel, as well as Diane Swonk to all weigh in before and after. Before that, 10 a.m., and this is what we were talking about, June new home sales. This is where we're expecting to see some sort of reacceleration, which we've seen even in pricing. How does the Fed deal with something like this, which this was supposed to be the most interest rate sensitive area of the whole market. And aftermarket, we were talking about this, Meta reporting earnings. Just to give you a sense of what we're looking at today. To date, we have seen 97 S&P companies, about 20% of market cap, report. Another huge chunk coming this week and then next week. But what I'm watching is this divergence between corporate spending and consumer spending. We have seen that consistently, where you see companies really pulling back, even as the consumer, John, continues to step up their spending.
A look out for ad spend a little bit later on Meta. Joining us now, I'm pleased to say, Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max is bullish through the rest of this summer, and it's the then what we're interested in. So, Max, let's talk about it. Why through the rest of the summer? What happens after that?
Yeah, look, good morning. I guess what we have right now is still a pretty supportive Q2 reporting season. You guys just mentioned it, right? When we look at, the latest tech earnings. But in total, I think I would say until then, we've had these pretty negative downward revisions in earnings expectations. So that means the bar to beat is pretty low. In fact, when we look at already sort of average earnings surprise factors or beat rates, they are a bit above historical averages for the US. So that's good. I guess there's a bit of perhaps even upside surprise potential on the manufacturing side in the US, right? When we look at things like CapEx intentions, regional Fed surveys, things like new orders over inventories, they've all been picking up in the US specifically. And all that would tell us perhaps that those two things over the next couple of weeks and months are pretty good. Thereafter, that's the question mark.
Describe the wall of money that's out there. One of the themes of late July is a belief that the money's there and on a first order condition, institutional money, whatever, is going to go into quality bonds and quality stocks. Has HSBC identified how much money is actually out there?
Yeah, look, indeed, when we actually look at real money investor positioning, right? So sort of how underinvested or indeed how exposed they are to several asset classes, what we can see is that since late last year, around October, they've been consistently underweight in things like equities and high yield credit, right? So they've consistently been parking cash on the sidelines or sort of hiding out in lower risk asset classes in anticipation of that US recession that so many were expecting, and that just isn't happening and is being sort of kicked down and down and down. So there is, I think, particularly among discretionary investors, particularly among real money investors, still an awful lot of money and an awful lot of underweight positions in those risk assets that really have to be corrected, I think, over the next couple of weeks and months. And that should keep the equity market in risk assets in general really quite upbeat in the next couple of months.
Max, I've got to give you credit. You were bearish last year, then you went full bull this year, talking about how you are expecting us to get ahead of the recovery on the other side. You extended that bullish call, the risk on call, through the summer. At the end of the summer, things might change. What would that be?
So I think you guys actually been talking about it, right? What is this fine balance, this fine line between activity is better, but on the other hand, that actually might mean that inflation is going to pick up a bit more, right? So we've got to try to figure out the point where the market says and where the market basically stops cheering the better activity data, the positive surprises on earnings and on top-down data, and when it starts to worry about inflation again. And to us, that really is sort of a worry perhaps towards Q4. Perhaps we're even too early for that, and we need to extend it towards year end and into the new year. But I think one of the concerns that we have is that US headline inflation on our measures is going to reaccelerate slightly into year end. And that might dent some of the hopes of sort of this continued immaculate disinflation. And then perhaps really investors are starting to worry a bit more, similar to what we had in February, a little bit more about, hey, you know what, better activity data actually means higher inflation, and that perhaps means a need to keep policy rates in restrictive territory for a bit longer.
A lot of notes that I've been reading and a lot of people I've been speaking to, Max, think that the Fed has taken a more dovish tone recently. You hear on the margins, the Raphael Bostics, but others as well come out and say, perhaps things are disinflating in a controlled way where we don't have to go too much further. Is that accurate? Do you think that that's going to have to change as we see signs of what you just predicted will happen down the line?
Yeah, look, I think that's exactly the danger, right? That we're all getting sort of lulled into, oh yeah, everything's fine. You know, we don't need a recession. We don't need any slowdown anymore. Everything's, you know, inflation is going to slow down by itself. We're all fine, Goldilocks, and you know, the S&P is going to go to 10,000. So that's a bit. I think the concern I have, that we're getting a bit too calm, right, in the second half, and we're all starting to agree a little bit too much with each other and saying, hey, you know, we've won this inflation battle, it's completely over, it's a disinflation for the next year and a half without any kind of concerns. So in fact, when we look at our economists' projections for the next, let's say, 18 months on Fed policy, we're much more hawkish compared to the market and compared to consensus. So that really is the key concern. For us, it's not the concern around recession. It's not the concern around an earnings recession or margins. It's really the concern that perhaps we're getting a little bit too comfortable around the inflation trajectory too soon.
You know, Max, I look at the call in the stock market, and I mean, I believe it's the fourth longest Dow Jones Industrial Average track. There's broadening out, you know, all the themes. You're writing about them each and every day. What does all this good news mean for the stocks that have already advanced 30, 40, 50%? What do you do with the glory stocks of 6 months ago?
To be honest, you still buy them. So we're still overweight in US equities more broadly, right? So still quite like the whole tech story, the whole Goldilocks story, right? That whole disinflationary story is still intact, right? Don't get me wrong. This is a worry that comes perhaps down the line in 3 to 6 months. But until then, right, we can still play this disinflationary wave in the US in particular. And on top of that, the better activity data and the better earnings and the resilient margins. So that's still this sort of pretty nice Goldilocks picture where in total, what you want to do during those in this environment is you want to go broadly short dollar, long the growthy part of the equity market and long carry assets like emerging market debt or high yield
That's
credit.
CFA talk.
Is that right?
Growthy part of the market.
What level's that, Tom?
Level 5.
Max
Max got there, I didn't.
Chief multi-asset strategist over at HSBC, constructive going through the rest of this summer. And as Lisa pointed out, last year, right to be bearish. This year, right to be bullish. It's been a pretty decent 18 months for Max Kentner and the team.
Yeah, to review, and you were way out front of this, John. Looking at luxury here. I think you were looking at it really hard 6 weeks ago or so. This is the conundrum right now that Max just addressed. There's a lot of Andrea Feldstedt writing for Bloomberg, OMG, Arnaud, they're going to do the Paris Olympics, but the bloom's off the rose, worry this, worry that. Dana Telsey overnight just slices through the analysis, raises her price target from 925 to 955, an 11% lift from where we are right now. And that's the conundrum you've got is growthiness. What do we do with Google? What'd you say? It's up 6% pre-market?
Google is, yes, Tom. And if you look at some of the statements from the CEOs, both of these stocks, of course, Google and Microsoft, have been used as vehicles for your AI hopes and dreams. And it was interesting yesterday, just opening up the individual statements. First line of each quote from each CEO, Satya Nadella. Organizations are asking not only how, but how fast they can apply this next generation of AI. And then you heard this from the Alphabet CEO, our continued leadership, and guess what, Lisa, AI seems to be the buzzword of the moment, doesn't it?
And when you look at the earnings, where is the AI profitability? Where are those revenues? What it comes down to is ad spending, and what it comes down to is cloud spending, and what it comes down to is the nuts and bolts. Yeah. And then you have the investment. What do you make of Ruth Porat changing her title to Chief Investment Officer?
What is that? Okay.
I have no idea.
Does anyone know?
I don't think so.
So
I was
you're
looking.
You're transitioning from CFO to president and CIO. What is that?
It's a newly created position, and I was looking up more details. There were none that I could find in terms of what's she going to be investing in, AI, or is this going to be something else?
Ruth came from New York and went out there. She served 5 years of pain as CFO, and what they want her to do is ride herd on the many dream investments and bolt-ons and this of the founders and of recent Google is, well, she's the one that's got to pick up the debris and figure out what to do with it.
Well, I'm pleased you've got a better understanding of this than I have.
Chief Executive Bolt-on Officer.
Oh, that clears it up.
Wall Street have been big fans of that individual for a long time.
Yes. Yeah.
Just curious to see that shift from CFO to some newly created role. Seema Shah in the next hour. Principal asset management on this equity market. Equities a little softer. Meta after the close. Chairman Powell a little bit later from New York. Good morning.
biggest threat remains inflation. We've had some good news on output growth. We've revised upwards a little bit, and there was quite a bit of resilience in the global economy, but especially in the first quarter. But, you know, the momentum is slowing down, and this is why, at the end of the day, the revision is not stronger than what it is, and why we're going into next year also with relatively modest growth.
The International Monetary Fund with a mild lift to their forecast for global growth, but ultimately, as the IMF chief economist pointed out, they're looking for modest growth into 2024. Live from New York City this morning, good morning to you all. Chairman Powell making his Federal Reserve decision a little bit later on this afternoon. Most people on Wall Street anticipating another hike from this Fed. It's about the what's next. And the what next, the clues for what's next, you'll get in the news conference shortly after the decision. 3-day winning streak on the S&P 500 going into potentially that Fed hike. Equity futures right now on the S&P negative by 0.1%. Microsoft, a major weighting in some of these benchmarks, of course, makes up about 10% of the NASDAQ 100, I think. And NASDAQ is getting hit just a little bit more because of this move in Microsoft, down about 3.5% this morning. The NASDAQ is down by 0.2%. Yields are going absolutely nowhere, 388.85. The euro's been going somewhere and all over the place, Tom, over the last couple of weeks. We've had 6 days of euro weakness replaced by a single session of euro strength. Euro dollar 110.75. Positive by 2 tenths.
Since Lisa's been gone, we've had an adjustment in euro, but also I'd note strong yen today as well. It's some interesting dynamics in FX to the weekend. What I would note, John, into earnings season, well, I have yet to see a summary. You mentioned it earlier. 40%, 20%, 80% of earnings are all happening within 10 days. We're going to be a lot wiser about the growthiness and the valueness out there in 6-8 days. I mean, a lot wiser.
It's about 40% of the S&P 500 market cap this week. I had a question for you, actually, Tom. Entry price leather goods. What's the entry price for leather goods at LVMH? Do you know the answer to that? They said they're softer, they're weaker, apparently. What is an entry price leather good at LVMH?
Entry price is the partition here. For example, at Tiffany's, where they've just spent $1 gazillion, including having a beautiful display of Audrey Hepburn's dress from Breakfast at Tiffany's. I don't know if you know this, John, but there's a floor devoted to entry price. It's called silver. And, you know, they don't mention it, but you go up and it's gold this, gold that, and there's one floor for floor 12, floor 18, I can't remember where, which is all silver, and it's like entry price. And this is, you know, this is the huge deal. I would suggest, and I'm speaking completely uninformed as an amateur, we have to ask the question, were U.S. sales down because of a lack of Chinese tourists? I mean, I think that's
an interesting question,
a really
Tom.
interesting question.
But we've seen this at Richemont. We talked about it yesterday going into this print from LVMH, and you've seen it, Lisa, from LVMH. US seems to be a soft spot for some of these luxury players.
And China was a strong spot. This is the irony. We've been blaming China for the slowdown in potential, or the potential slowdown in luxury sales. It's not. It's in the U.S. By the way, I'm looking at Givenchy bags, purses. They go for... Oh, here's a cheap one for $1,650.
Is that cheap, is it?
I have no clue. This isn't really my purview. But
well,
I will
entry
just
level,
say,
are we talking about wallets, purses, belts?
I don't think that's entry level.
Belts.
I mean, a guy like, you know, come on.
Money clip.
You know, Terry Haynes knows they bulldozed. Just this is west of Ford's Theater, where David Rubenstein and others put so much into part of our national character, and they basically bulldozed 6 blocks of Washington D.C. And Terry Haynes knows you can make a circle there from Tiffany over to Gucci, go around to Bottega. I mean, that's the whole luxury branding.
That's your DC shopping lap.
Yeah. And we're going to do that right now. We're going to lighten the wallet with Terry Haynes here, founder of Pangea Policy as well. I look out the window of our office, Terry, at what they did to Washington. It's not the Washington I knew from my childhood as well. Terry, August beckons. John's brought this up a couple times. We're going to have a Republican debate. It is illogical that they can have a constructive debate without the former president of the United States. How are they going to do that?
Well, they might have a more constructive debate in some ways, Tom. It provides the challengers an opportunity to differentiate themselves, firstly. Secondly, if Trump isn't there, it gives them an opportunity to punch without being punched back. There's probably some value in that, too. So, we'll see how that goes. But, that's about a month away now. So it tells you a lot about how little will come out of Washington in the succeeding weeks that we're already talking about something that will happen probably 4 or 5 weeks from now.
In the air-conditioned August doldrums of Washington, what are you focused on this weekend? Most of us are unfocused. Help us get focused. What matters right now?
The phrase that is on the lips of everyone in Washington is 2 words: jet fumes. The deal will be to try to finish the week and get out as much as possible. Beyond that, what you've got is a few different inquiries. So there'll be some heat on Homeland Security Secretary Mayorkas. There's the bubbled up talk about potential impeachment inquiries in the fall or in the winter, and finally, I know it won't be lost on you, Tom, that there's going to be a UFO hearing today in the House too, cheap joke, but some people would go right at that number 1, so I'll leave it for number 3.
Really, people are going to go to the
This
UFO
is a big deal.
hearing.
It's a big deal.
The UFOs or the
I think
the balloon?
Scully will be there. She'll be in the back.
The frequency of the sightings
You're not even able to say
is much higher than people previously appreciated. And we're going to find out more detail about that today.
You can't
just how
even
much
say
the
that
US
with a straight
government has been
face.
hiding from us, Bramo, about what is happening above this country in our airspace.
And there's going to be sort of like an off-key pitch behind
This
us
is
the
you
whole
joke.
time.
It's really important. Bet you're talking about it tomorrow. You'll see.
Okay, well, meanwhile, we are talking about the real world as well. And Terry, I would love to get your thoughts quickly on the meaning behind the UPS deal with the Teamsters, especially as we talk about inflation ahead of the Fed meeting and what this could mean in terms of wage inflation. We get ECA on Friday. How do you think that President Biden is going to weigh in on this at a time where inflation is a concern, but where he's considered the most pro-union president out there?
Well, it's interesting that, he's at the same time that he's the most pro-union president, the Teamsters essentially stiff-armed him and told him to stay away from it because they thought they had a better shot at a good deal. So that's happening. We will still have some strike activity going on, and it'll be through the summer and the fall, and it'll still be beyond the White House's ability to try to successfully resolve any or all of those. So I think net, it's going to be a bit of a drag on the economy and kind of feed into inflation fears, which, is a data point that going forward, is likely to inform the Fed's future track as well.
Terry, everything the president says right now is under a microscope because of his age going into the campaign next year. There was a quote yesterday that a lot of people are mentioning in different ways and taking their angle on it, that they need to based on who their audience is. Yeah. What did he say about ending cancer, Terry? What did the president say?
Fundamentally, this is a follow-on to the cancer moonshot that he's been touting and pushing ever since the days when he was vice president. That effort will continue. There will be some funding from the Congress that will continue on that. But beyond that, I don't think it was anything particularly meaningful.
Terry Haynes of Pangea Policy. Terry, thank you. Much confusion over that yesterday, Tom, as to whether the president said he had ended it or we can end it as we know it.
I'm glad you brought it up because to me the confusion is not a single item. It's happening every 4 days, every 8 days. Where are we in a year, frankly, with both of our aged candidates for president? Where I don't, Rishi Sunak, what's Rishi? He's like 38 years old.
38 years younger than him, maybe.
Sunak was playing for Portsmouth 6 years ago?
Tom, it seems like an off-the-cuff silly statement, but at the end of the day, I just think the way the media reacted to that in the last 24 hours, just an example of what this is going to be like for the next 12 months.
Exactly. For the next 12 months is the key phrase.
You know that Tom said you'd been in Norway for the last week.
Yeah,
You're aware of that.
Wasn't too far off.
Tell us all about the fjords.
I actually went to fjords.
Did you see a polar bear?
But not the Norwegian fjords.
But not Norwegian fjords.
You didn't see a polar bear?
We did not see a polar bear, no.
No.
Damn. Get a refund.
Is that the review?
That's the review.
That's the review.
I was in Alaska.
Well, here's the price action if you've tuned in for equities. Equity futures on the S&P negative by 0.2% on the S&P 500. On the Nasdaq 100 down about 1/3%. Microsoft making up about 10% of the weighting of the Nasdaq 100. So there's a reason why we're a little bit softer on the Nasdaq relative to the S&P this morning. I'll get to those earnings in just a moment. In the bond market, 2-year, 10-year, 30-year. Treasury shaping up as follows on a 2-year, 485.78. Yields a little bit lower on the session. Go back to the middle of June when the Fed last met. At the close, your 2-year, 469. So interesting that we've had this inflationary, disinflationary development between the last meeting and this one. The Fed backing away potentially from the idea that we get 2 hikes, maybe we only get a single one. And the 2-year in between the meetings, Lisa, higher, not lower from last time around.
And this, to me, is one of the distinctions that I expect to hear more and more about. How long can they hold rates at the highest levels, which is expected to go up since 2001? And how much is that going to become a focus? Because if they're not cutting rates, what does that do to the rest of the curve?
That's the bond market. Let's push it through foreign exchange. The euro, 6 consecutive days of euro weakness against the US dollar. We replace that with a touch of euro strength, 110.82, just short of 111 and positive 0.2%. But TK, you and I have been talking about it for the past week. The data out of Europe just not getting it done. Not good going into the ECB.
Edge of idiosyncratic. I mean, I got a 27 on lira. I'm not there fixed, 26.95. That's idiosyncratic. I'm going to suggest this week euro is about European GDP weakness because DXY, the blended index, 54% euro. DXY really hasn't moved. This is a euro-specific story.
European
and
Central
Lagarde has
Bank
to face that.
Decision coming on Thursday. BOJ coming on Friday. Before we get there, under surveillance this morning, investors expecting the Federal Reserve to raise interest rates by another 25 basis points. A hike today would put rates at their highest level in 22 years. Two-part story today, no projections, so you get the statement at 2 p.m. Eastern Time, then you get the news conference with Chairman Powell at 2:30. In that news conference, Lisa, I think you've touched on the most difficult part of today for Chairman Powell. There's clearly a splintering on the committee. How do you reflect the consensus of the FOMC when maybe there isn't one in this news conference?
Maybe he should come out and say there isn't a consensus. We don't know, just like you don't know. And there's some people who think that we are in a steady disinflation and others who don't. We don't know what we're going to do next. We do know we're going to hold here for the time being and observe this, this, and this. I don't think we're going to get a lot more guidance. I mean, honestly, what else can he say?
Not much. That's the Federal Reserve. Look out for that. A little bit later, we get earnings from Meta. Before we get to Meta, we've had earnings overnight yesterday evening from the likes of Alphabet, gaining in the pre-market after beating expectations, particularly on advertising. So maybe that's a clue for Meta. Microsoft this morning heading in the opposite direction. Tom, just a sequential slowdown, deceleration in cloud growth, cloud spending growth, and that's weighing on the stock.
Yeah, I get that. I thought Anurag Rana was brilliant yesterday on this. It's a risk. Somebody's going to be right. Somebody's going to be wrong about the vector of cloud growth. But I don't hear anybody saying you're going to see a strategic change in cloud. I will say, John, there's a little bit of zeitgeist saying, here's Google doing better. Here's Microsoft doing better. What's it mean for Amazon? And let's remind ourselves that cloud guy came over to take over the company when Bezos went to take over the Washington Post.
Jassy.
Yeah. So that's sort of the triangulation of cloud in America, at least right now.
Next Thursday, Amazon and Apple. You said zeitgeist. This is in the zeitgeist, TK. British billionaire, Tottenham Football Club owner, Joe Lewis, facing charges of insider trading in the United States. We're hearing that federal prosecutors claim Lewis passed on insider knowledge of businesses he was heavily invested in to friends, assistants, and even romantic partners. It's an important quote, Tom, we've got to read out from an attorney for Lewis saying this. The government has made an egregious error in charging Mr. Lewis, an 86-year-old man of impeccable integrity and prodigious accomplishment. Mr. Lewis has come to the US voluntarily to answer ill-conceived charges, and we will defend him vigorously in court.
I thought the Bloomberg coverage of this was very balanced in that they talked about some of the allegations here. Obviously, there's two issues here. One is he's innocent until proved guilty, and also I need to say thank you, Mr. Lewis, for the 2 seats to the tots.
Okay.
This is what I was waiting for.
Becca, I'm not biased
At
on
least
this
you've been
at all.
transparent.
I mean, I just was waiting to find out.
I'm biased. I think the prosecution's going to bring in Harry Keene to provide some evidence.
I'm pleased you're taking this case very seriously.
There's some serious allegations there.
Can I share one?
And, yeah, we'll share one morsel. There's many.
Just some colour that he loaned his pilots $500,000 each so they could buy shares before a company's clinical trial news became public. That's the allegation. Right. That's the allegation, one-off.
In the CFA curricula, about 15% of the exam is ethics, and what you flunk in ethics is insider trading. It is opaque, amorphous. It's not a lot of clarity here. But boy, are some of those allegations providing clarity.
Do you think this disrupts your transfer strategy this summer?
I think
season?
Mr. Levy would say no. I think that we need to do some reporting on this. And John, I got to be honest. I mean, we have our legendary R days here at Bloomberg, and I think you and I are going to need to take a bunch of R days
day
to research this. I think an arsenal tots.
We've got Francis Donald of Manulife with us. And, Francis, I just can't believe how transparent TK just was over a legal issue.
Well, in the CFA curriculum, they talk a lot about transparency, and they talk about how you shouldn't even give the appearance of conflict. So, Tom, looks like you've done a great job there.
Yeah, but the other issue is who let her in? The major issue here is insider trading is not as clear-cut as the public thinks. It can get really back and forth about who said what when. I was stunned by the allegations, I would think. Francis Donald is with us right now. We say thank you. Thrilled you're here this morning. What are you writing about this weekend on Y equals C plus I plus G plus NX? What's the dynamic there? Is it investment, or is it the mystery of this buoyant consumer?
We are trying to stick to process even as price moves against our base case, which is that, yes, still all of our leading indicators and our economic model suggest that the best base case scenario is indeed a recession in Q4. Now, that's not actually the game. The game as an asset manager is not to say whether there's recession or a soft landing, but to get a sense as to what markets will price in and out over the next 3 to 6 months. So what we're talking about is that in the next 1 to 2 months, we actually see economic data that will still give the appearance of soft landing. That's an opportunity to chase some risk. But if you're looking further out, if you're looking beyond the next 3 months, we still have to maintain this call. It doesn't feel good as everyone moves towards the soft landing thesis, but when you stick to the leading indicators, we have to say that is the best base case.
What does it mean to lean into risk right now? What are those areas?
Well, there is, even as a macro strategist, as an economist, I can say sometimes you need to participate in momentum-driven rallies. This happens. Macro is not always the primary investment driver. Again, that is not the most comfortable thing to say as a macro strategist, but an overlay, and it matters much more at inflection points. I do not believe right now we are at an inflection point, even though today is a Fed meeting and it may feel that way. That inflection point is to when that recession will probably come back into the story is probably 3 months from now. So if you want to play off momentum, sentiment, and technicals, now is the time to shine if those are your strengths.
Did somebody overnight push their recession call out to 2025? I'm going to say Goldman Sachs, but I'm making it up.
I didn't see that.
Somebody out
25.
there. I mean, everybody's pushing it out, not 2024.
Well, they have done all year.
Yeah,
They just push it another 3 months.
Another
3 months.
Can you raise it to 2026?
Sure, and I'm sure that if you asked any economist, they would have some sort of recession over the next 5 years, because I don't believe that cycles are necessarily dead. But it's a good question, and we ask ourselves this all the time, which is, why hasn't the recession that everyone's forecast materialized? It's probably because, and again, you have to look at what a standard economic model would tell you. You also have to say what may be not true about that model, or what's different about this environment. And a lot of strategists have said this time is fundamentally different. My view is that, well, you can't throw the baby out with the bathwater. There are elements of this story that are going to be very different. This recession that occurs later this year and into 2024 will look slightly different. Unemployment rate probably not going to rise to the same extent. And you do have to question, why isn't it here yet? That's probably because you have what we like to call cycle extenders in play. Things like labor shortages, excess savings. We're not talking, you don't need a PhD to figure out that there are things that are different about this story, but negating all of history, negating all of the power of leading indicators, to me, is not prudent in this environment.
So Germany has a recession.
Yes.
Europe still has an inflation problem. As you anticipate that growth downturn in the United States, do you also envision that maybe we have a sticky inflation problem too simultaneously?
Yeah, absolutely. And this is actually what concerns me more. We spend so much time talking about recession or soft landing. There are a heck of a lot of environments in between those two things. And frankly, if I'm an asset manager, which I am, and trying to figure out how to invest over the next 5 years, a classic recession rebound, we have a playbook for that. You can do well in that type of environment. What concerns me more, what we don't have the playbooks for, is what Europe is experiencing now. Sticky high inflation with no growth. One thing I'm worried about is actually this concept of the soft landing being green light, being the most bullish outcome. I'm not sure that a soft landing is as bullish as everybody makes it out to be, because we have 4 cuts priced in for next year. And if we don't get those because the economy is all clear, we have a re-rating to be made in a variety of risk assets. I'm not sure that we've really thought through what does soft landing mean for equity markets. It's not as bullish as it may appear.
How much do you think it's a bear market trap almost to lure people back to the 60-40 ahead of what you just explained in terms of the vulnerabilities in that type of maybe soft landing, but high inflation, no growth kind of circumstance?
Well, again, it really depends on your timeline. If you're operating on a 1 to 2 month timeline, it's not a trap, it's an opportunity in order to really leverage what we'll probably see is some cyclicality, some cyclical bounce in things like manufacturing data. But if you're a longer term investor, absolutely you should be looking at these bullish runs as opportunities to add back to quality and maybe reduce your risk. I think it's also going to call into play why there's a lot more focus on alternative assets and private assets. Because in this type of environment, one that John is describing as slower growth, recessions with sticky high inflation, we're going to be looking for asset classes that really reduce that volatility and are less correlated with the 60-40.
Asking for a friend, is the meeting this afternoon, is the press conference this afternoon a snooze fest?
I hope for markets that it is, and I would expect that Chair Powell also hopes that it's a snooze
fest. But what's
fest.
your prediction here?
I don't believe there is anything that Chair Powell could say today that would convince the market to take out rate cuts from next year. And that's because just about everybody recognizes that the Fed does not have the luxury of pivoting. What's happened since the last meeting? We've got ag prices surging, inflation expectations in the longer end of the curve are up quite a bit, and financial conditions are easing. He has no choice. He cannot go dovish. If he does, it'll be a little bit of an accident. So this is a market that's probably going to start putting a little less weight on what the Fed says and more on what 2024 is going to look like.
How do you think he manages what is increasingly looking like a broken consensus on the FOMC?
Well, that's a tough one. Probably like a lot of strategists are doing, which is coming out with a base case and then thinking through all the other scenarios behind the scenes. Goldman does a good job about talking about a base case and then a probability weighted base case. So the Fed can start talking a little bit more about scenarios, but it comes back to the issue that the Fed has to control inflation expectations. I think this is a big theme for the next 5 years, that central banks will have to have a moment where they admit we don't know what's always going on. And secondly, we can't combat all elements of inflation. That's going to be the story for how markets trade around central banks over the secular theme.
Francis, this was awesome. Come in the studio more often.
I'd love to.
I love it. Francis Donald of Manulife. On the Federal Reserve a little bit later, and market opportunities as well, and the risks out there too. TK, I think for most people today, even if you believe they are one and done, this is a Fed that today tries to retain the optionality of going again, which will shape to some extent what they expect from Chairman Powell in this news conference later.
I predict right now we're going to see him say data dependent. I just think it's like AI. We're going to see data dependent, because that's what they are. And maybe, it took out everybody some slack. It is a post-pandemic. We've never been here, but maybe with a pandemic, we're more data dependent than we've ever been.
I imagine the first 30 minutes might be a little bit silly if they edit the first paragraph at the very end when they characterize inflation as being elevated, if they acknowledge some kind of disinflationary improvement.
Yeah, possibly.
We'll see if they make a change there.
He won't say transitory. I don't think that word will
After getting burnt a few times.
I don't think that'll come
You know a journalist's going to ask. Maybe Mike McKee a little bit later in the news conference. From New York City this morning, good morning. Equity futures a little softer. This is Bloomberg.
It's really hard to argue against big tech for the time being, but it's also difficult to rationalize the sort of sustainable reaction of the tech market. How big can the big tech grow?
Deepak Puri there, Deutsche Bank International Private Bank CIO, asking, I think, a question we've all asked as the year has progressed. How big can the big tech grow? And the answer's bigger as the year has progressed. Equity futures right now on the S&P negative by 0.1%, on the S&P 500. On the Nasdaq, a touch of underperformance this morning. We're down about 1/3 of 1% as Microsoft slips following results, showing a slowdown in the cloud services business. Dan Ives of Wedburst remaining bullish on the software company, writing this: we believe Microsoft is in the early innings of a massive penetration of AI and cloud that could conservatively approach 50% of its global installed base over the next 3 years. We maintain our outperform rating, TK. They raised their price target from 375 to 400, reflecting what they call confidence in an AI opportunity over the next 12 months.
John, 1994, I was standing in the kitchen looking around the corner at the Bloomberg FXC panel, watching the market at 7 p.m. in Asia open in 1994, and there was a thing on the screen called Dogpile. To make a long story short, Dogpile was bought by Google as a key part of their search algorithm. All the others, there were the names I can't even remember now. I didn't see, as wired in as I am, I didn't see the internet coming. I've had the honor at Davos of telling Tom Berners-Lee at this. And what Dan Ives wrote yesterday on this is critical. It is now again 1995.
To have the faith that you can have that kind of transformational
moment.
Dan Ives alongside us this morning. And good morning, Dan.
I couldn't tell my eyes.
It's good to see it. I thought you were going to say at the corner of my eye I saw this fluorescent jacket, and that's when I met Dan Ives. Dan, I always reflect on this video, and you've heard this story before, forgive me, but you remember the clip from 60 Minutes in the late 90s, and there's this very sort of smug journalist asking an analyst about Amazon being bigger than Sears and saying, bigger than Sears? And you look back on it 30 years later, 25 years later, and it sounds ridiculous. So in moments like these, I try and be maybe a little bit modest about what I don't know and try and be a little bit, humility is the word maybe, yes. Bramo, just, try and have some humility about this AI moment. Dan, do you think we need a bigger dose of humility about how big this could be?
I mean, I think it's even going to be bigger than the street is even anticipating. And I think what we saw from Microsoft and Google just further confirms what we saw from NVIDIA. I mean, the use cases are exploding across the board. And I look at this as a 1995 moment, biggest transformation that we've seen in tech in 30 years. And I think that's why this is just what's going to lead, obviously, despite Fed and macro. It's the start of a new tech bull market, in my opinion.
There is the nuance, though, when people start to dig into what does AI mean and which areas are the investable and most lucrative areas. Is it going to be generative AI, where basically you can go to any retailer, put your avatar in, try on clothes, and then order things? Or is it something else? What are you looking for to determine who the winners are going to be? Yeah, well, right now, New York City cab driver knows that the first derivative, NVIDIA and Microsoft. And I think that's been proven again, top of the mountain. Now it's all about who's second, third, fourth derivative. It's really software and chips. When I look at names like Salesforce.com, MongoDB, you look at Snowflake, I think that's really just tip of the iceberg. I think others across the chip ecosystem. And what we're really starting to see now, it's all about use cases. That's why right now investors, they're just looking, if you look at, it's expensive on next year's number, it's really looking out 2, 3, 4 years. I believe this, from everything we're hearing, it could be 8 to 10% of budgets next year for IT from less than 1% today. So if you take a look at the price action today, with Microsoft shares lower, because they didn't necessarily deliver on the profitability of AI yet, they can't, they're investing still, and they're not delivering as fast of some sort of investment on the cloud space. What would you say to investors in terms of how they should look at this valuation, how they should look at some of the rejiggering of the top executives, and put a price target on that? Yeah, it's a great question. And that was all my conversations last night and even earlier this morning with institutional investors. Look, Nadella, the tactician, the Hall of Famer. I mean, this is just getting the popcorn out ready for what I view as actually an accelerating growth story. They're not going to, they're not Cook style going to give their playbook away. They're going to keep this conservative, and I view just a sandbag special as they continue to just beat numbers over the next few quarters, which is why I believe Microsoft, a year from now,
it's going to join Apple in that $3 trillion, I think $3.5 trillion, what I see in a year.
George Hammond writes in the FT today about the AI crew. He's got Anthropic, Google, Microsoft, and OpenAI. Okay, I guess that's the new industry organization around this. The Luddites are going to show up. We're going to do a 19th century redux here of the damage of AI. How do these giant companies with the profitability they have handle the 21st century Luddites?
Look, I think stronger can get stronger. There'll be some self-regulation. But ultimately, if you look from a regulatory perspective, they're going 20 miles an hour in the right lane. Technology's going 100 in the left lane. So I think really the stronger and get stronger. If you look at Microsoft, you look what we see out of Alphabet, that was a huge flex the muscles corridor for them.
Oh, I like the CFA talk.
And
flex the muscles.
It was a huge flex the muscles quarter. And that's, look, this is one, if you're a bear now coming a little out of hibernation mode, thinking that you want to...
Why are you looking at me?
No, if you're a bear coming a little out of hibernation mode,
right.
I think ultimately what you saw from tech earnings, just more and more bullish.
Okay.
And I think next week is going to be the golden moment.
That's where I want to go.
Cupertino next Thursday.
I don't care about all this AI talk. I want to know about next Thursday, Amazon and Apple. Amazon's not in that list of AI companies. I think they're in the cloud. Apple certainly isn't. How does Apple embrace AI? How did they get on this list of these companies?
Cook continues to play chess, others play checkers. And I think what we believe it's going to be an AI-driven app store. Gurman's hinted at some of the AI technology, but I ultimately believe the next 1-2 years, that's just going to be a further penetration story. Adds $30 to $40 some of the parts to Apple.
Can it protect their margins down the income statement? How many beeps can Apple pick up on EBITDA, let's say, out of AI 5 years out?
AI combined with chips, you're talking incremental 300-400 bips. That's just
300 bips
300 to 400
improvement.
bips improvement because they own their ecosystem plus AI being pure software margins.
How quickly do they get to $4 trillion market cap off a 300 bip improvement?
I believe we will be
years.
sitting here in early 2025 getting ready for Super Bowl and Apple will be $4 trillion.
Okay, breathe. So I acknowledge that in the late 90s there were some real things that we didn't appreciate. We also got sold a lot of BS. So can you explain to me, and I wish we could curse on this show, could you explain to me what is an AI-generated app store? What is that?
So that's ultimately going to be, whether it's health, fitness, any types of apps developers are going to build, they're going to be AI-generated with all what I would call generative AI technology that will be built within the App Store. So ultimately, any Apple user will be able to download those apps for developers. Just like we have the App Store today, the next version of that is going to be an AI-driven App Store that I believe Cupertino will ultimately come out. And I think they're actually starting the concept of it with, Vision Pro and ultimately a new form factor.
In the meantime, it's not going to be about that. It's going to be about how many iPhones they sell. For a long time, you've been bullish on this upgrade cycle that kind of never was. And it's always been the justification for why the stock's got to go further. So a lot of people that haven't upgraded, they're going to buy the iPhone 13, 14, 15, and then it kind of remains the same and pretty stable. What's going on there?
Street numbers have moved up 15% on iPhones. So the thing is, the bears ultimately thought sub 200 million, but yet they sold 225 million because they continue, and Keene, the tactician, knows as well as anyone, they continue to underestimate the golden install base of Cupertino, which is why I view this as a mini super cycle playing out. And I think Apple next Thursday, Cook on the call, that's just going to be further what I view as fuel in the engine for this upgrade cycle.
Here's the upgrade cycle. I just took a photo of Dan's shoe. The saturation on this phone is so superior to anything.
And it still doesn't capture the colorfulness.
It doesn't capture
of the knives.
And look at that camera
the
technology and the chip.
Isn't the Samsung camera better?
Yeah, but this is a really important point. Overnight, we got 30
Hasn't
seconds.
It always been better?
When does Samsung just give it up? The report overnight was not good.
Look, Samsung, Everest-like uphill battle, another sort of black eye for them. And I think ultimately it continues to be more and more share gains for Apple. And I think, look, Samsung, it's a continued struggle that they have again and again.
Dan, it's good to catch up.
Thanks,
I know we're going to do this
Thank
together the
you.
next week.
I'm
looking forward to it. Thank you, buddy.
I'm going to put this out on Twitter. Ives Unfiltered.
Unfiltered?
Yeah.
Just a picture of his sneakers?
Yeah.
Okay. Dan Ives of Wedbush. So much more than just a pair of Nikes. Coming up, Seema Shah of Principal Asset Management from New York City this morning. Good morning. Futures right now on the S&P 500, negative 0.1%. We talked a lot about Microsoft and Alphabet. Next week, you'll hear from Apple and Amazon. After the close a little bit later, you'll hear from Meta. And before we get there is Chairman Powell and a Federal Reserve decision. Special coverage through today right here on Bloomberg.
Inflation remains well above our longer-run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
I would say we're close, but we still have a bit of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Fed decision just around the corner, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio, alongside Tom Keene. Bramo's back. I'm Jonathan Ferro. Your equity market's negative by 0.2%. Chairman Powell, 2 p.m. Eastern Time. We get a decision, then 2:30 a news conference. Tom, a little bit later after that, earnings from Meta, following numbers from Alphabet and Microsoft yesterday afternoon.
And we're seeing Coca-Cola right now. Lisa, jump in here. I mean, John, I'm sorry. This is a big deal here. Organic revenue growth 8 to 9%. That's the heart of this earnings season. Everybody thought, John, those numbers would come down for Meta, for the rest. Everything's going to come down. You know what? I'm seeing a lot of research notes saying, maybe not.
What we're seeing right now is Coca-Cola raising their guidance for the full year. That's what a lot of people are looking for, with earnings per share coming in at 78 cents, beating the 65-cent projection. But what I find interesting, John, is even in the lower end items, you're seeing consumers able to keep spending above expectations. And that is the story that the Fed needs to pay attention to.
Discretionary spending has remained elevated away from the staples and some of those names out there at the moment. It's been a year of airlines and cruise lines, Lisa.
And we've seen that pretty consistently, both front up and personal
Are you
as
living
well.
it?
I'm living it as well in terms of the crowds. But this really is the conundrum, and it goes to what we heard from Francis Donald. What is the risk that the disinflation trends are a head fake, and then what we're seeing is something that will be stickier even as growth slows and people's discretionary spending pools, pots of money, start to wane?
Two names. Max Kettner, HSBC. He came on a programme an hour ago and he said he expects inflation to reaccelerate. Andrew Holdenhorst, Citi, expecting inflation to reaccelerate. So let's get a third name. You mentioned the guest just moments ago, Francis Donald. She was talking about a recession, Tom, but a recession with sticky inflation. And if you're scratching your head about that,
that's a belief.
Search no more, look to Germany. That's not a belief, that's the reality. Got a recession in Germany. Inflation's still a problem for this ECB as they meet on Thursday.
Well, let's be clear here, folks. And I think, John, you and I said this yesterday when Bramo was away. The basic idea here is the ECB meeting is more important than what we're going to do today.
I think it's fascinating.
Obviously Chairman Powell's not going to mention it, but he has to be aware as central banker of the world of the challenges of Germany and, frankly, France, and how it redounds over onto the America.
And how does he express hawkishness when everyone knows he has to express hawkishness? He has no other option. And how does he give any convincing argument for it at a time when you're seeing more splintering on the FOMC than you have in months?
I can't tell you how many notes I read yesterday afternoon that said some version of this. We think one and done, but they retain the optionality to do more in September.
When we leave, you keep working?
I keep working.
Really?
I read research, Tom. Do you do any of that?
It's pretty shocking.
Any research, TK, in the afternoons?
I don't know. That's a Roman day.
It's a Roman day.
We call those Roman days. It's like you're working like the Romans years ago.
Okay.
Yeah.
Did they work more or less than us?
They work 80 hours a week.
I imagine they work less than us.
I clock out at 10:01. See ya.
Well, I clock out with you at 10:01 too.
Yeah, but you keep working. I don't.
True.
I'm off,
Equity futures on the S&P look like this. On the S&P 500, we are negative by 0.2%. In the bond market, we are virtually unchanged with a 10-year at 3.89. And a euro, unlike the previous 6 sessions, showing some strength today. Lisa, euro dollar 110.81.
And really the main event is going to be at 2 p.m., as you were mentioning, where we get the FOMC rate decision. If you want to join us, you should. We can start at 1:30 p.m. We will be back. You will not be clocking out at 10 a.m. We're going to be back in the building, and we have Bill Dudley, the former New York Fed president, Bob Michael of J.P. Morgan Asset Management, and Diane Swank of KPMG. 10 a.m. before that meeting, we get June new home sales. This, to me, is the conundrum, a reacceleration in a space that was supposed to be interest rate sensitive. We saw prices climb a bit higher on the month-over-month reading yesterday. And after market meta earnings, and this does follow what we saw already from Google or Alphabet and what we saw from Microsoft, the consumer discretionary spending, the retailer spending on advertising, that has been strong. Corporations not spending as much, and that theme, I think, is really interesting, John.
Looking forward to the earnings a little bit later from Meta. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, wonderful to catch up with you on a Fed decision day. Let's start with Chairman Powell. What are you looking for in the news conference later on this afternoon?
Hi, John. So we have had a fairly long-held call that rates will peak at 525 to 550 in that range, which is where we're going to hit today. That is fully priced in. It will provide no shock to the markets. As you said, the real interest is going to be in the press conference and what is Powell saying. And you just have to look at the strength of the economic data to know that they almost have to put aside the most recent CPI print, which was softer than expected, and really focus on that continued stickiness of inflation or the threat of a resurgence on the tightness of the labour market as well. So I think it pays them well to make sure that they maintain their hawkish stance. They cannot risk a further easing in financial conditions. So I think that's going to be his tone. But we have to remember Powell, when it comes to question time, has a tendency to let his true self out. So that's going to be what we're watching.
Is the mistake, which is what everyone seems to be looking for. What kind of dovish mistake might slip from Chair Powell? In the meantime, one after the other of some of the cautious investors have been putting up mea culpas, including Mike Wilson of Morgan Stanley, saying he got it wrong with respect to the rally. You've been cautious. Have you thrown in the towel and said you need to lean into this rally? Or are you saying, OK, perhaps it hasn't borne out the way that we thought, but it will?
So we're a little bit in between. So as you said, we have been cautious. We have been expecting the economy to slow a lot more than what we've seen so far. We've been right on the Fed decision. So it's a slightly weird situation where you've got the inflation numbers almost correct, but the growth numbers haven't, matched up in that way. From our perspective, we are expecting a further pullback or a pullback in equities. But because our recession call is one for one, which is very short, very shallow, a 2-quarter recession, a 1.5% peak to trough in analyzed GDP growth, very, very small. So we are expecting to see a bit of a pullback, maybe a 5 to 10% move, and then we're going to be looking to get really risk on. But we're not at that point right now.
So do you shrug off the idea that we were hearing from Francis Donald, from Max Kettner, that you could end up with some sort of slowdown but still sticky inflation, which creates a non-optimal moment for risk on?
So I don't know if I'm quite there. I do think that you're going to see a slowdown in economic growth. And I think one of the things is, what do you define as sticky inflation? We do not buy into the argument that the Fed needs to see inflation at 2%, 2.5%. We think they'll be fine. So I think the thing is that we are expecting to see continued deceleration as the economy slows, and that the Fed will be in a position at some point next year to start cutting rates. That doesn't mean that they're going to move into loose territory. I think that policy is still going to be very restrictive. If we're wrong about the economic growth scenario, and actually you do see this continued melt up in the economy, well, yeah, then that's going to be accompanied by a resurgence in inflation, and then you're looking at further Fed hikes. But I don't think we're sitting right in the middle between those two.
Seema, I'm so glad you're here because I've got something on the Bloomberg screen I've never seen in easily 30 years of dealing with a Bloomberg terminal. I got Coca-Cola with a 3% FX headwind, lower than the drama of last year. FX is getting more stable off dollar. But I've got at the revenue line unit case volume of 0%, and the headline right after it says organic revenue growth is being modeled at +8, +9%. I've never, ever seen that spread between 0% and an 8% view for the future. Can companies raise into this inflation cycle? Do they just keep raising prices, or does that end at some point?
I think it has to end at some point. But you're going to see this bifurcation with companies, right? The companies that have the brand, that have the pricing power, will continue to maybe creep in some of those price increases. Coca-Cola is a great example. That's got a really strong brand. That is likely to be one of the outperformers. If you're a smaller company which doesn't have that branding power, as inflation is coming down, you're going to find it more and more difficult. So for us, as well as taking that big macro view on where you want to be focused, you do need to start thinking about that pricing power, brand quality, and whatever your view is for the economy. If you believe that inflation is coming down, that has to be a part of your strategy going forward.
Does Principal see value in international investment right now? I talk about 2023, my theme for the year, the Great Zombie Roll-Up. That's implied American. Can there be a Great Zombie Roll-Up to scale and quality worldwide?
Well, look, I think there are opportunities internationally. You have to look for them really carefully. And one of the things is because this environment is quite difficult to read. You know, we've been talking, there's a lot of difference in views at the moment. You almost have to start focusing on some of those, longer term themes. So for example, for us, when we look at international equities, we're thinking about reshoring. Where is that reshoring taking place, especially as China continues to disappoint? So there's going to be areas within EM Asia, which are looking pretty good. In Latin America, where you have reshoring really as a key focus for parts of Mexico, those valuations are also looking quite attractive. And you have some central banks which are starting to cut interest rates. So I think you can look outside the US. The tech story in the US, I think, is still compelling from a long-term perspective, if maybe a little bit dicey in the short term. But that, for us, is the way that investors should be playing this right now. Don't think about the near term, because it is quite confusing. Think about what you're looking at over the next year, couple of years out.
Assuming the risk on choice was basically, do you want luxury out of Europe or tech out of the United States? Do I want luxury out of Europe after what I've heard from Richemont and LVMH in the last week?
No, you don't. And the reason is it's not actually about the European consumer necessarily. It's really about China. So, as Lisa was saying before, in China, actually, the consumers are doing okay for a lot of these companies. But what you're not seeing is some of those this kind of spillovers to other economies. And one of those is the luxury goods sector in Europe, which was anticipated to benefit significantly from China's strength. Now, you're seeing a Chinese recovery, which is very, very lackluster. But also, any of the benefits that do exist in China are just not spilling over to the other markets. So I would still play the tech trade rather than the luxury trade in Europe.
LVMH down 5% in European trading this morning. Seema, thank you. Seema Shah of Principal Asset Management. These fears over the European market creeping back in based on the data out of China. We had some happy talk out of the Politburo a little bit earlier this week, encouraging maybe a lifeline in Chinese equity markets, which have struggled relative to the performance we've seen elsewhere. But Lisa, is that sufficient, just talk, or do we need to see some real stimulus come out of that country?
I was reading an article in one of the analytical journals about why China cannot stimulate in any kind of sustained way. They can't go back to the same well of housing and inflate a bubble if they don't solve some of the entrenched political problems with the local governments, if they don't solve the problem of it not responding to supply and demand dynamics. And that, I think, is the quagmire they found themselves in.
Are elements of a balance sheet recession starting to emerge in China that maybe you just can't do much about? If you are just tuning into the program, welcome to the program. On the S&P 500, we are negative here on the S&P by 0.2%. Coming up on the equity market in the next hour, looking forward to this conversation, Alicia Levine of BNY Mellon Wealth Management. Always one of the best, TK. That conversation just around the corner.
Really bringing a lot of mathematics into it. I really want to talk to her about the tail risks that are out there right now. I think we're going to get some optimism from her, but it's not only the tail risk, but also, John, the tail risk of the gloom of the left over to the right tail, which is the optimism that's out there. I wonder this weekend how people again recalibrate to a bull market.
Looking forward to catching up with Kathy Jones of Charles Schwab as well. She'll join us in about 15 minutes. Before we get there, we need to get down to DC and catch up with Bloomberg's Anne Marie. Sometimes the good news are things that didn't happen. The good news for this administration, the strike from UPS, Bramo, that probably won't happen now because we have, I understand, a deal on the table. Good news for the Biden administration, I'd say.
Massively good news, partly because there was a concern about does he step in and stop a strike that would halt a major part of packages that I know Tom Keene and many others rely on every day for their basic goods and then some. And that really was a concern hanging over it. Now the concern shifts. Wage inflation. How much union pressure is there going to be? And this isn't just the Teamsters. There are a whole host of real labor pressures that are percolating up.
I'm going to talk in the 8 o'clock hour to Sean O'Brien, who's the head of the Teamsters. What an interesting story out of Local 25 in Boston. And it's real simple. My first question to him is Amazon the next UPS for the Teamsters?
Interesting. That conversation a little bit later on this morning. Coming up next, Anne Marie down in Washington. Your equity market negative 0.2% on the S&P 500 from New York City. Good morning.
I think it's quite likely that we're going to have a shutdown. There is a group in the House that thinks a government shutdown would be a good thing, both politically and in terms of governance. And the bottom line is we cannot run our country, one, without a budget, which we still never really have, but two, with this amount of chaos. Shutting the government down cannot be the solution. We have to fix our broken budget process, and we have to figure out a way to compromise on the actual budget.
The crisis that never was on repeat over in Washington, D.C. That was Mayor McGuinness there, the president of the Committee for a Responsible Federal Budget on Balance of Power in the last 24 hours. From New York City, welcome to the programme. Big day ahead for many of you. Federal Reserve decision a little bit later. Consensus view, we get a rate hike. Then it's about the news conference and the what next from Chairman Powell 30 minutes after that. So 2 p.m. for the decision. 2 p.m. Eastern Time, 2:30, 30 minutes later, you get a news conference with Chairman Powell. Going into it, equity futures on the S&P 500, just a little bit softer on the S&P. TK, we're down here by 0.15%. No drama this morning.
No drama. I'll go with that. But again, I'm with you. I'm looking tomorrow to Lagarde and the ECB and how they finesse true slowdown there, is mentioned by IMF, even with a little bit of IMF optimism. Yesterday, John Torsten Slok publishing moments ago, and this is in the zeitgeist this week. It really hasn't been talked about. We mentioned it yesterday on the show with some fixed income strategists. Loans. These aren't car loans. These are not house loans. They're packages of what I'm going to call fixed income, not derivatives, but structured securities, oftentimes leveraged. And Torsten Slok puts that in the zeitgeist at Apollo today.
Defaults are starting to pick up.
Yeah, this is Abramowicz.
We're hearing more and more about that, Tom.
Yeah. And I don't think it's a small issue. I just, and Bramwell, where are you on this? Are leveraged loans the same as a bond?
They're usually sensitive and they increase in rate with the increase in benchmark rates, which means they are that much more interest rate sensitive. You are seeing concern there. And yesterday, I'm sure you guys talked about what we saw out of Europe with a massive decline in loan demand, the biggest decline going back to at least 2003. And that, I think, is what we're going to hear about from Christine Lagarde tomorrow.
We're going to go to Washington right now in the sleepy days of July into August. Much going on. Terry Haynes giving us a Pangea approach here on some of the politics of the moment, but far more seriously, and with security around her when she's on the lawn of the White House, Anne-Marie Horder on what matters to dog lovers in America. Vet Bill asked me to ask this question. Anne-Marie, you gotta be kidding me. Everybody growing up knew a dog in the neighborhood like Commander. Commander's biting Secret Service agents. I mean, this frankly is not funny. Is Commander going to Happy Farm out in Delaware? How do they solve this? If they can't solve this issue, how can we believe the president can solve the nation's serious issues?
Well, it's a good question when you frame it like that. This dog, there's several emails are showing, has bit a number of Secret Service agents. They did have another dog, Major. He had followed a similar track, and he was sent to a family, friends in Delaware, and potentially Commander's going to face the same fate. That's all the details I have on this.
Have you ever met Commander? I mean, have you ever, like, you're hanging out in the White House in the East Room like you do, or the Green Room, the Oval? Have you met the Beast?
I've seen him run around unleashed in a garden part of the White House, but I never wanted to go over to him, and I love dogs, but I never had this urgency to want to go pet Commander.
There you go, Lisa. This is the insight you get from Balance of Power every night at 5 p.m.
Are you trolling Anne-Marie?
No, I think it's great. She's out there. She's at risk on the White House lawn.
I will say,
continue.
It was interesting to me what it says about where we are in the news cycle also, that this was the top story for a lot of political outlets, was that there were attacks by the dog. It is potentially a serious story that I'll let other people deal with. I am curious your thoughts on the resolution that we got with UPS. We are going to be speaking with the head of Teamsters coming up, but I'm curious from your vantage point how this is being received in a White House that did dodge a bullet on one hand, but also is facing very much of an inflation problem on the other.
I think the White House is breathing a big sigh of relief. I think Teamsters made it pretty clear they didn't want the U.S. government, they didn't want the administration to get involved. They wanted to hammer this out themselves with UPS, and they were able to get a deal that they seem to be happy with. Of course, this is a provisional deal. They have to go back and make sure that this can get through all the members of their union. Remember, there was a hiccup last time with the railroads because there were some members of the group that were just not going to go forward with it. But it does seem like this is a deal that they are happy with. And it is just a huge sigh of relief for the president, because many were thinking, I mean, Greg Valliere in his note today said his thought process was there would be a day or two at least of strikes from UPS workers. And that would have been incredibly troubling for this administration, for the Fed, that they are trying to bring inflation down to 2%. Could that have stoked higher inflation? Could have been another issue for the supply chain bottlenecks this administration for a year and a half really tried to work to unwind. So this is something that, of course, is welcomed by the White House. And anytime you're seeing a union president come out and say that they are fighting for higher wages in America, this president is going to want to embrace that. He wants to go down in history as the most pro-union labor president, and it comes at a time where this is the kind of rhetoric he'd want to see going into 2024.
And this is probably what he wants to be the headline instead of his dog and potential bites, and instead of other things that are coming to the fore. What does that say about his popularity as we head into an election year at a time where the race is really heating up with potential Republican contenders ahead of next month's debate?
Well, the president's approval rating is about in the 40s. The issue he has more so is that his economic approval ratings is in the 30s. I still cannot get over this Monmouth University poll that says only 3 in 10 Americans think the U.S. is doing better coming out of the pandemic economically than the rest of the world, because this administration continuously likes to show that coming out of the pandemic, look at U.S. data versus the rest of the world. We're doing much better. Yes, when you look at the data, it does feel like America is out front coming out of the pandemic. But the issue, of course, is that is not how Americans feel. They are still feeling what we had in terms of higher inflation. Yes, inflation is cooling, but prices were still elevated, and Americans are still feeling that. And that is a huge problem going to 2024. And it is why the administration is trying to own this term Bidenomics and explain to the American people all the legislative wins they've had and potentially try to shift them on how they feel about the economy. The other big question, of course, is whether or not we would see a recession before 2024. But if there is a soft landing, the timeline could potentially be helpful to this president.
MH, thank you for everything, man. Anne-Marie down in Washington, D.C. on a range of stories. Problem is for the president, Tom, Bidenomics means different things to different people.
Oh, yeah, come on. It's a concept.
As always.
You throw it out, see if it sticks on the wall. And, as you say, it means a lot of different things to different people. Guess what? Bidenomics is about the next jobs report. It's about the next inflation report. You talk about data dependent, you just stagger forward with these political phrases.
Is it about the front cover of the New York Post? Have you seen that headline on the New York Post? That is brutal. That is brutal. You brought up the dog. I don't bring up the dog. There's an easily startled, confused creature in the White House prone to fits of anger. There is also a German Shepherd.
Personally, I've been through this with a dog. It's not funny. And the answer is you got to fix it. I mean, the issue is not the bite. It's the bites, plural. I mean, come on. It's
not the first time.
Not the first time.
But I think to Lisa's point, the fact that that's the front page this morning, and it's not about avoiding a strike that could have included, Lisa, 340,000 union members.
That's the issue.
That's the problem.
And the perception and the fact that every gaffe and every trip and everything gets highlighted in this new way is a serious problem. And you do wonder what the Democratic Party is thinking about that, as you do have a host of potential Republican suitors lining up in Milwaukee.
Who's going to turn up to that debate stage next month?
Good question.
What I'm fascinated about, and this is what the pros like Anne-Marie bring up, is the money raising. I've never been really focused on money raising, but every single adult we have, including Matt Shirley, who arranged is all this for us, they all talk about money first. I don't. They do.
Did you see Ron DeSantis cutting a significant
35%.
part of his
Mike
staff?
Pence can't raise money. That stunned me. Terry Haynes even mentioned that. He was shocked at what Pence cannot get done.
I believe that Republican debate clashes with Jackson Hole. If you noticed that.
We have team coverage from Wyoming. We get Jim Cheney, the former vice president.
Maybe we go to Milwaukee first.
Exactly.
Get the two Cheneys. The two Cheneys lakeside. Two Cheneys lakeside.
Equity futures negative from New York. Good morning. It's a dog-free zone for the next 10 minutes, or maybe the rest of the morning. I can't predict what TK is going to talk about. From New York City this morning, good morning. Equity futures on the S&P 500, slightly negative on the S&P by 0.16%. Bit of underperformance on the NASDAQ. We're down there, Tom, by 0.2.
F1, qualies are Friday, not Saturday. What's that about? What is a sprint race?
So we've got a sprint race.
What is it?
This weekend.
I don't understand. Explain.
It's shorter, no pit stops.
Why do they do it? It's like a pre-race.
I still don't really know the rationale for
good.
it.
I don't feel like an idiot.
I'm not a big fan of it. I think it takes something away from race day on Sunday.
And qualies on Saturday were like lights out.
Yeah.
I mean,
I'm with you. We're on the same page about that.
Okay, we're on the same page.
I'm not sure where that conversation came from, but I'm
also,
with you. I'm pleased that was top of mind.
In the pit, dog free. In the pit.
You hope. Yeah. You hope, otherwise that would be chaotic, Tom.
Let's continue.
Let's get to the bond market. 2-year, 10-year, 30-year. I wonder if Daniel Ricciardo comes up in a minute, but I've got no idea. Yields unchanged, 388.46 on a 10-year, 2-year. Yields lower by a single basis point, 486.40. We did this in the last hour. I think it's worth doing it again. It's an exercise I do every single Fed meeting we have. I compare the market to where it was at the last Fed meeting at the close. And Lisa, back then the 2-year was at 469. We're higher now. The 10-year back then at the close was 379. We're a little bit higher now. And that's developed even with evidence that we're embracing this disinflationary soft landing.
There's a feeling the Fed's going to have to keep rates higher for a bit longer, but not long enough to torpedo the rally. And this is the uncomfortable balance that people are trying to justify at a time when the Fed has to somehow signal something about inflation that is basically a mystery right now, where indicators aren't really giving a pretty good read.
And no mystery over at the ECB. The ECB's got a problem. Inflation's sticky. Germany's in recession. PMIs this week, terrible. German business confidence, not great. The euro has had a string of weakness, 6 days of it. It's bouncing back today by 0.15%. The euro against the dollar, 110.72. Under surveillance this morning, investors expecting the Federal Reserve to raise interest rates by another 25 basis points. A hike today would put rates at their highest level in 22 years. Two-part story, decision at 2 p.m. Eastern Time. Then you get a news conference with Chairman Powell at 2:30. The first paragraph of the statement is where my eyes will go initially. How they characterize inflation, Lisa. At the moment it reads, inflation remains elevated. Do they embrace the improvement, the progress we've made more recently?
And if they do, how do they avoid an accident? Because most people would say that is really teetering near an accident of sounding somewhat dovish when they have to sound hawkish, because everyone's just going to assume that they're going to be more hawkish than they actually are. I mean, basically, this is the psychology of these meetings that Tom loves, and I know that we will be parsing through today. Join us at 1:30, going all the way after the meeting. That's a promo.
That's the promo. We can't wait. Tom might stay awake the whole 2 hours. I might stay awake with him as well. And
touch and go.
Tune in just to see if that happens or not. Earnings later after that. Romain Bostic and the team, Scarlett Fu, Katie Greifeld are going to break down what happens with Meta. We need to break down what happened with Alphabet and Microsoft overnight after the close yesterday. Alphabet's positive by 6% in pre-market trading, beating expectations, particularly in advertising, which might be a read across for Meta. Microsoft heading in the opposite direction after a slowdown in crowd services. Really not enough to offset what is positive in terms of the artificial intelligence story. Microsoft this morning is down by about 3.6%, TK, and I believe we had Boeing just moments ago.
Boeing's moments ago. I mean, Lisa's up to speed on this, but it's real simple, John. Boeing, and I wasn't aware of this, it's single digit over the last 10 years. It's been with all the news and airplane problems and that. 9.1% return per year for the last 10 years. Lisa, off the bottom of October, up 82%.
And this highlights the divergence that we're seeing right now. You were talking about Microsoft and Google, and it really is the consumer spending that's fueling some of the ad-driven gains that you're seeing in some of the tech names. When it comes to consumer spending, Boeing is going to take advantage of that with plane orders suddenly picking back up. We saw Hilton just a moment ago as well, beating expectations. Why? Everyone's traveling, everyone's moving around, and this story is really going to continue throughout earnings, and we've seen it. For how long remains the question.
Pretty decent beat from Boeing this morning. Stock is up in the pre-market. The last story I think we need to stay on top of, never mind the dogs and all of that stuff and the gaffes at the president. This is the story right now. UPS reaching a tentative agreement to renew a 5-year labour contract with the Teamsters union. This has avoided a strike, potentially, and we hope it will, that could have started as soon as next week. Teamsters President Sean O'Brien saying this: we put a lot of pressure on them in the media. We put a lot of pressure on them in the street, and we weren't going to reach out to them. They blinked. Tom, maybe this captures the moment we're in for Labour and Labour leverage right now, but this could have been a real strike month end. 340,000 people.
A giant backstory to this, which is really important about Sean O'Brien. I'm not going to go into it now because our guest here, John Forward, is so important. But this is a kid, and I mean a kid, out of Local 25 in Boston who went up against all of the stereotypes every viewer and every listener has about the Teamsters. He did this a number of years ago. It involved immense courage, and the payoff was today. And the first thing out of his mouth is Amazon's next.
They blinked and Amazon's next.
His basic take is years and years of UPS. When he took over, he would suggest they screwed it up with UPS. They fixed it overnight with an agreement. They came to an agreement that benefited both the employer, Big Brown, and also the Teamsters, 300,000 plus people. And he's moving on to that model applied to other union-type organizations. And I would suggest if you drive down 3rd Avenue, Amazon's part of that discussion.
Teamsters President Sean O'Brien coming up 8:45 Eastern Time, an hour and 10 minutes from now, TK. On this program.
It's going to be interesting to see right now in the bond. John, I'm going to bounce it back to you here. It's Kathy Jones is with us. She's chief fixed income strategist at Charles Schwab. And I think this is underplayed, John. There's been real stasis here, the real yield stasis, 10-year yield stasis. All my radar's up on the bond market because it's boring right now.
Kathy, let's get to it. Will it be boring at 2:30 Eastern Time?
Oh, I'm sure we'll get some excitement, you always do. But, as you said, that's widely anticipated. The Fed's going to hike, and then what's forward guidance going to be? And I think the expectation is they'll sound hawkish, but they may indicate a pause. How does that get parsed out in the Q&A session? What does Paul kind of communicate here? Will we get a dissenting vote? Possibly, or at least a hint that a handful of Fed officials are not on board with more rate hikes. That could communicate a lot to the market.
We've spoken to a couple of people this morning who think that inflation reaccelerates later this year. I just wonder if that's in your base case and what it would mean for a yield curve right now that's already deeply inverted.
Yeah, we don't have a real acceleration in inflation built in. There's a lot of disinflation in the pipeline that is still flowing through, especially when you look at wholesale goods prices. And we're not seeing that huge amount of pressure on the inflation side. Of course, you have oil, which is going to be there, but ex-food and energy, it doesn't look like we're seeing a reacceleration at this stage of the game. Growth is still substandard. It's been 5 quarters of 1.5% GDP growth. It's really hard, I think, to push the inflation narrative from there.
Would it be bad if Jay Powell came out and said, we have no clue. We don't know where this is going. We're going to pause. Raphael Bostic is going to dissent because he probably will, because he's been the lone dove out there that's been pretty vocal. All of us aren't sure. Here's what we're watching. Call it a day. Why can't he just do that?
I sort of wish he would, to tell you the truth. But I think the Fed they have forecasts, they have to communicate some sort of confidence about going forward. But, the truth is they don't know. They never know. Nobody really knows what's going to happen in the next few quarters. They can only follow the indicators and the trends. We have, as Tom mentioned, very high real rates. We have tightening credit at the banks a lot. And we'll get the senior loan officers, I think, pretty soon. I would imagine the Fed has done some work on what's going on behind the scenes at the banks. We're not waiting for the quarterly report to come out. So they may have a feel for just how tight credit is getting. So those are all going to go into the equation. And then QT continues. We've still got that going on in the background. So tightening is still happening, even if they pause. And I think that may be part of the message that comes out.
And one aspect of this, and we're seeing this in terms of 2-year yields going up as high as they have, higher than the previous meeting, even as risk assets continue to rally, can they, with conviction, say they are not going to hike next year and really push against people who are saying, well, it might be a recession? Could they give some indication of how high the bar is for them to really ease?
Well, Powell, I think it was last November, outlined 4 things that he was watching for a pivot, for a change in rates. And one was this disinflation from the wholesale markets to retail pricing. You could sort of say, yeah, that's happened. He's talked about a sub-trend GDP growth for a number of quarters, where I would argue we've probably had that over the last year or so. He talked about slowdown in housing prices, and we're starting to see that, but it hasn't flowed through to the data. And then I think that there's the wage data. And so we have to wait for that. So I think they could outline the criteria and then say, this is what we're watching. I think they've kind of outlined it in general over the last year or two. But we're waiting to see all of the boxes get checked. We're waiting to see everything kick in. And I would argue that, the labor data is probably the final one.
Let's go from 60,000 feet down to 6 feet. I'm over a kitchen table this weekend. I'm still not recovered from the bond debacle of 18 months ago. I thought bonds were always supposed to go up. What is the retail recommendation to participate in fixed income out to 2026?
So we like extending duration either with a barbell or, let's say, a ladder.
Ladder out is appropriate?
Yeah, laddering is fine because it takes you out of the game of trying to time the market.
Give us a duration gap on that, a maturity gap on how you ladder up.
Yeah, we like a 1 to 7 year right now, but it depends if you're in the muni market, you might want to go a little further out because the
like
curve
30
is
years
sloped.
or the Austrian piece?
No, Austrian pieces. No,
That's what
30
I did.
years.
I'm killed. This is a really important lesson, John. You ladder out with someone, an adult like this, and retail's laddering out. Should we go out 10 years or 20 years? Because they're yield hogs and they want to pick up yield. Ms. Jones is laddering 1 to 7. That's a massive lesson right there.
How's that century bond doing?
It's
in
killing.
Austria.
It's just
killing it or killing
it's killing him.
Yeah, I was going to say.
It's just,
It's amazing, at the time when all of that stuff was being issued, when Argentina came to the market, it was one of those moments where everyone knew. Everyone knew. It wasn't like you had that contrarian thought, well, this is a bubble, this is bad. Like, everyone knew it was. They also knew that negative yields was deeply unsustainable. They just got more negative and persisted for a long time, Lisa.
This is when you know something's truly a bubble. When people say maybe it's a bubble that can just exist in perpetuity.
Totally.
And bonds have a new place where it's really capital appreciation and the price appreciation, not the actual coupon, which is nothing.
Yeah, we were going to the bond market for capital returns.
Yeah.
And a monster bond market rally. That yields are negative, great, but they'll be more negative, and prices are going up. That was the story, the last 10 years, Tom.
I mean, it is. I mean, the whole last 10 years, last 16 years.
Kathy Jones, as well. Thank you. It's good to see you. Kathy Jones at Charles Schwab there. If you are just joining the programme, welcome. Counting you down to a Federal Reserve decision a little bit later on this afternoon. Your equity market on the S&P 500 looks a little something like this. We're negative by 0.16%. Looking forward to catching up with Ethan Harris of Bank of America Securities. That would take place at 8:30 Eastern Time, so about 45 minutes from now and change. Tom, we haven't talked about a banking merger that any other month over the last 3 months would have been headline news, top story. And I think it speaks to the moment we're in that we're not talking about the PacWest, Bank of California, or is it Bank of California?
It's Bank.
It's
but
Bank.
you can call it Bonk if you want to sound
French. California.
Yeah.
BNC for anyone who's not
a
following.
Marketing guy had an extra martini at Bank of California and said, change the K to a C, and we look sensitive if we do.
Do you actually know where that came from? I don't know where that came from.
Probably
if someone knows.
It's probably Bancorp.
Oh, is that what it is?
That's probably what it
there
is.
Was a type there.
Yeah, that's my gut.
This is a creative deal. It's got some equity kickers in it for some other people. Warburg Pincus is involved. I really don't know the details and don't care. What I know, John, is pre-crisis, if they come out at $10 per share, I'm just using that as a round number, we're down 80% from the glory times before the blow up. But critically, at the most gloomy, when the Bramocam was visibly shaking over the bank crisis, they're popping up 210% or so, up from 4 to 10. It's a nice rebound off the bottom.
It also highlights how some of the firms that got troubled reputations are having a lot of trouble climbing out of it without some sort of
I think that's an
acquisition.
Dead on.
And that's the issue. So it's going to take private money to come in and fund it.
Creative transactions.
The change now, though, it's their problem, not ours. That's the consensus view, and maybe it becomes everyone else's problem again.
Bonk. Is that the subway stop by Queen Victoria
Bonk.
Street? Bonk?
Yeah, that's what we call it,
Get off
Tom.
at Bonk.
You should ask where that is.
Bonk.
It's really hard to argue against big tech for the time being, but it's also difficult to rationalize the sort of sustainable reaction of the tech market. How big can the big tech grow?
Deepak Puri there, Deutsche Bank International Private Bank CIO. Big tech growing a whole lot bigger through the year so far. A little bit smaller if you're looking at Microsoft this morning. Microsoft at the moment in the pre-market is negative by 3.6%. The AI hopes and dreams, not enough to bail out decelerating cloud revenue growth, which we can talk about in just a moment. Alphabet getting it done. Alphabet positive by 6%. Google up in the pre-market. Ad sales trends look decent over there, Tom. The stock's doing nicely. Meta rising off the back of that initially yesterday in sympathy. Snap doing anything but. I don't know if you've looked at Snap.
I could not believe it. Oh,
brutal.
my God.
If you can get Snap up, take a look at that.
If you can't move socket wrenches off of that, I mean, I looked at it and I just said, you know, inventories in Ohio were terrible there for Snap-on tools. I mean,
down 17%. Snap, not Snap-on tools, Tom. Snapchat.
Oh, okay.
Yeah, different company. Different
this is like social media. I've never done Snap.
I was hardly pivoting from.
Should I pivot from
Microsoft to Snap?
Threads to Snap.
You should check it out, Snapchat. I don't even have that on my phone. Yeah.
Lisa, have you ever snapped or whatever
no,
they do?
but the kids do.
You snap.
They love it.
They love it. And the reason why is because they can see where their friends are. And so they stalk each other using the Snap app to find out where people are, ostensibly to hook up and meet up and get a sense of that, to meet up with their friends. But it's also basically where are they that I'm not? Are they actually there?
And so after that,
they actually track each other and it becomes a social issue. Are they all together without me?
That's so weird.
Yeah.
And then the mother snaps. Is that what happens?
They're come on home. No,
the
I don't
changes.
snap. That was really cheesy.
Can I ask a rhetorical question, John? I've never asked this question. Ever. You're not, Mandeep, you see how they don't pay attention to me? It's like I'm not even
We
here.
change the subject every 5 minutes. I've got no idea where
Can
we're going.
I ask you a question? Is Boeing a technology company?
You've done it
Seriously.
just now.
I'm sorry. Boeing is up big. We're talking tech. Boeing is loaded. Those beautiful planes are loaded with technology. They're going to use AI to fly us pretty soon.
Why don't you ask Mandeep Singh that question, whether they're going to use AI? Look, there's actually a real question here underpinning that, which is not somehow going to Boeing earnings. But this question of how are all companies going to be pitching AI as a reason for them as tech companies, especially retailers and others that have a lot of data that they're going to use.
Fascinating. Let me cut in. Let me change the subject. Can I do that?
Not the dog.
Great. I love our audience. So much smarter than me. That's why I adore you, because they sent me this. The answer is straightforward on Bank with a C versus a K. Okay. At least for Bank of California, the California Financial Code states that in order to conduct business under names that include the word bank with a K, a firm must have received a certificate from the commissioner authorizing it to engage in commercial, industrial, or trust banking businesses. Holding companies like Bank of California own banks but do not themselves operate as one, and so must use the term bank. B-A-N.
It's brilliant.
C.
It's
All right.
brilliant.
That from our colleagues over at BNN Bloomberg. And thank you, sir, on the Bloomberg terminal for sending that.
I learned something.
That link across.
Didn't Bank of
I
Bank
didn't
of
know
America?
that, so that's great.
I didn't either.
We got to get the Mandeep here, and I guess we'll go there, Mandeep. And Lisa brought this up in a call. I said, it's got all this AI BS what we're talking about. Reminds you of nanotechnology, except is Boeing a tech company, and will Boeing be affected by AI?
Well, if they start talking about AI and they start giving numbers, which Microsoft did last night, they told us how much revenue they are generating from these new AI services. 250 million, not a whole lot, but it grew 90% quarter over quarter. And I think the stock is down because expectations were even higher. Okay, so look, you can only aggregate the data points. NVIDIA told us they're raising their forecast by 4 billion because of the AI demand. So it just puts it in context.
That's the two people in the heart of it. But if Dan Ives tells us that Microsoft's going to see a 300 beat pop in margin, or Apple, whatever it was, I think we get that. Is Boeing or other companies using technology going to see a margin expansion 3 to 5 years out off of AI?
Probably not, because one thing everyone is realizing is with this wave of AI, you need huge upfront investments in terms of building your data centers, buying these chips, really aggregating a lot of data. And when I say lot, I mean, we're talking about the whole internet, and everyone is getting protective about their data. So I think it will be a handful of players, and it will be mostly tech companies. But the internet companies, I think, are well positioned, and we saw that with Alphabet last night because they have the most data. When you talk about companies that have digitized everything, It's the internet companies. It's not the Boeings of the world or the Caterpillars. I mean, they are looking to digitize, but they're still very early.
You mentioned investment. How seriously should we take this new role for Ruth Porat, going from CFO to president and CIO? What is that?
I think, I mean, it's twofold. One, they want to retain her. Clearly, there is an element of that. And also, in terms of Google looking to take stakes like they did with Anthropic or, new Gen AI companies, they can't buy any company right now with the, the current setup. So what Microsoft did with OpenAI is they took a $10 billion stake very early on. Maybe Alphabet may do the same, and they already did that with Anthropic. They may be looking to do more of that.
So you think this won't happen organically at some of these firms? They're ultimately going to be small companies that these big beasts, Microsoft and Alphabet, just take stakes in?
I mean, the transformer model on which this whole generative AI is built on was came up from Google. And so it was a 2017 paper that was written by Google employees. The fact that they didn't do anything for the next 5 years, and now we are talking about this wave where OpenAI has become the new buzz, it tells you something that they are slow to change. And that's why these startups will still be nimble. I think Google has the advantage with infrastructure. But clearly, I think the innovation will happen in these startups.
For now, people are looking for where the cash is coming from, and it isn't yet coming from the AI investments. It's coming from advertising more than anything else. And we've seen that divergence really with ad spending delivering and corporate investment in the cloud not delivering. How is that going to color Meta's earnings after the bell? Are we going to see that advertising benefit them as well, the way that we did for Google?
I think some of Google's beat last night was search doing well, but also the cost efficiency side. So you're going to see the same, cost-cutting efforts play out at Meta. They've pared back their investments when it comes to Reality Labs and Metaverse. That will feed into the free cash flow. Alphabet talked extensively about how they are reducing their hiring for the second half. And look, these companies have the incremental margin leverage. So on the ad side, ad spending is coming back, but we saw that with Snap. It's not coming back to the point that it's lifting all the boats.
How long before we start to hear some of the tech companies talk about AI replacing their programmers, actually allowing them to make further job cuts?
Well, look, I think because of the changing nature of, AI and what cloud is doing, you will find certain jobs will get obsolete. And these co-pilots, I mean, what they are doing is essentially replacing people who are just making, small changes that could be repetitive. And that's where co-pilots could be huge in terms of what it could do around, how many tech employees you need, the programmers you need. So that's where I think the co-pilots aspect is huge in terms of what sort of leverage these companies can get, both internally as well as what they could sell to their customers.
Mandeep Singh of Bloomberg Intelligence. Mandeep, this was wonderful. It's fantastic to hear from you, as always. TK, I was listening to a podcast yesterday with the brilliant Sam Rowe, someone you and I both respect and adore. I think it's fantastic. Okay. Yeah. And he was reminding everyone that when it came to the likes of Facebook, they didn't create Instagram, they bought it. When it came to the likes of Alphabet, they didn't create YouTube, they bought it. And what Mandeep's getting at when it comes to AI, what's going to happen here is they're going to invest in things. Now, with the benefit of hindsight, when those deals were made, we look back, I remember thinking, well, that's a lot of money for Instagram. Well, that's a lot of money for WhatsApp. And 10 years later, look at us now. They look like phenomenal deals, and the government's annoyed with themselves for allowing those deals to happen in the first place. And Mandeep, I know you've got to run, but I just wonder whether even the investments of some of these big tech firms now will come under the microscope, knowing down in Washington that these big tech players could get a whole lot larger based on small investments that could be made right here, right now.
They will probably come under the microscope, but I would say they have the scale, and all these small startups need the scale more so now than they did, 5-10 years back, because this is very compute intensive. All the generative AI is compute intensive.
I mean, I look at this. I look at iRobot yesterday with Amazon. We were talking to Carol Masser about it, who's encyclopedic on iRobot vacuuming her living room. I mean, why does Amazon buy iRobot? Why do they do that?
I agree. I think they're not trying to make money off the hardware. They're really trying to. Yes, it's the technology.
They wanted the floor plan in our rooms and stuff like that.
Carol Masser's
that's what it's about.
Carol Masser's at lunch downtown. We get her on the phone with Paul Sweeney, and Carol Masser's encyclopedic on vacuuming your house with these robots.
They want to understand how big your room is.
Do you have one of those?
No, I do not. Not giving away that data.
That Bill's going to ride it.
Of BNY Mellon. up next from New York. This is Bloomberg.
Inflation remains well above our longer-run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
I would say we're close, but we still have a bit of work to do.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Right. Good morning, everyone. This is Bloomberg Surveillance on radio and television. Fed Day. Thrilled you're with us. Lisa Abramowicz has returned off Norway, Svalbard, wherever that is, looking at whales and the rest of it. Lisa, nice of you to show up for Fed Day. Jonathan Ferro is always here as well. That was the best opening of the 8 o'clock hour I've seen in years. John, what a bunch of hot air. They were wrong 6 months ago. They were wrong 12 months ago. They were wrong 18 months ago. And Ben Bernanke, Ethan Harris, writing Ben Bernanke's Fed, would say they've been wrong since McChesney Martin.
It's nice to see you fired up and engaged because last
What a
week you were
bunch of hot
declaring,
air.
you were talking about a victory lap at the FOMC only a week ago.
They can have a victory lap in real time based on data, but this crystal ball gazing, the dots. I had dinner once with Richard Berner, iconic at Morgan Stanley, and we were talking about, you had Arthur Burns smoke signals, you had Greenspan, what was a sandwich at lunch? That's more sophisticated than we just heard in the show opening.
Well, Bernanke unleashed maximum transparency coming out of the financial crisis, and Tom, once the toothpaste is out of the tube, you can't get it back in, and this is what we live with now.
Important question. Does the Bank of England have maximum transparency as a young institution? They're still feeling their way through that.
I don't get the same sense that those officials are running around doing speeches with quite the frequency that I see from officials on the FOMC. I think the ECB's up there. Hear from the ECB and President Lagarde all the time. In fact, I think you hear from President Lagarde more than you hear from Chairman Powell.
On the lawn at Frankfurt years ago, I was like, who the hell is that? It's young Pharaoh. Young lad on the lawn at Frankfurt. The ECB tomorrow is a changed institution. There's massive challenges there of Bundesbank, hawk-like, versus others going, you got to be kidding me.
Well, you mentioned the Bundesbank. Germany's in recession. So I don't think the decision for them is that straightforward either. And what's been interesting for me over the last couple of weeks is not to listen to the doves. It's the perceived hawks on the Governing Council who won't commit to tightening beyond July. So you get a hike at this meeting potentially on Thursday, but Germany's in recession, the PMIs are dreadful, business confidence isn't great, and inflation's still a problem. Now, is that a lesson, a case study for what we might experience stateside? I don't know, but it's pretty fascinating this Thursday.
Clear the mind. She did what I've never done. She saw orca whales or something off Greenland. Very cool. Lisa Abramowicz, you've had your mind cleared here the last X number of days. What's the toxic brew that we're going to see at 2:30 today?
Well, I love your setup, by the way, for Fed Day. Your tease ahead. They've been wrong forever. All these smoke leaves, it's ridiculous.
Like
Watch us. We're going to be on at 1:30.
I prefer the way it used to be.
Okay, fair enough. However, they were dominating and keeping their thumb on the market for more than a decade. It was the Fed's market. It was the Fed's bubble. It was the Fed's Austrian 100-year bond, as well as all the other central banks. How do they communicate what that new normal is? And increasingly, that's the focus. How long are they going to keep rates at the highest level going back to 2001? How long can they basically say, even if we don't get a recession, we can cut rates if we see some sort of significant slowdown in inflation?
They're data dependent, and to me, your wheelhouse, Lisa, is a key data dependency as we're pricing bonds to perfection. The jargon here, folks, is spreads come in. Have you seen any wavering in that into this Fed meeting?
Spreads are the tightest on high yield bonds, the extra yield over benchmark rates, the least going back to April of last year. Question is, how much is this a legitimate reflection of a lack of defaults or a perceived lack of defaults in the same way that we've seen traditionally in downturns? And how much is this a mispricing as people look for risk in every corner?
Off the radar, John, I'm looking at Brent crude rounded up, $83. That's not $79.
Let's get into the cross-asset check. Equities this morning on the S&P 500 shaping up as follows, negative by 0.16%. Microsoft disappointing, a deceleration in cloud revenue growth. That stock in a pre-market is negative by about 3.65%. The story for Alphabet, that stock in a pre-market is positive 6 percentage points. Ad sales, pretty decent. Looking ahead to Meta after the close. Maybe want to watch after the Fed decision later on this afternoon. Tom, your 10-year, 388.66, yields basically unchanged going into that.
Everybody's got a different act on Wall Street. Alicia Levine is head of investment strategy and equity advisory solutions at BNY Mellon, and what she does differently, the distinction is she brings prodigious dynamics and mathematical abilities to the show. What's the interesting thing in the left tail, Taleb's huge risk, the black swan out there, in the right tail, which is where the Dow up 47 days in a row is? Tell me about the tail distribution right now if everybody's loving the Dow Jones Industrial Average.
Look, the tail distribution is enormous here, but a little bit shallow, meaning that the left tail has slowly shrunk, but still bad, and the right tail has moved out further and a little bit fatter, and that's what you see in the market. It's very hard to say we're not going to end in a place where the Fed just keeps on breaking something. Hard to say that, but on the other hand, the evidence so far, just look at housing yesterday, Case-Shiller, like housing, if that's the leading indicator of where the economy's going and the transmission of Fed policy, we've bottomed. So how can we bottom with the Fed at 525 here?
Right. So on a partial differential basis, how do you reallocate on 60-40?
So look, we do think ultimately there is a recession out there, but there's always a recession out there. Like we're in a business cycle. So we think that you're going out a little bit more on duration, although I do think there's risk to over 4% here if the economy stays strong, and the Fed may have to relook at its path and its dots. And we never went underweight equities. We always stayed fully invested. I remember sitting here a few months ago and you said, how do you not go 5% cash? And I said, well, we don't do that in our client portfolios. We're always invested. And so our clients have taken advantage of this upswing because in the end, you can't time the market. And with better than expected data, when all of Wall Street was expecting the apocalypse, this is what you get. You get the melt up. And now it's moving into other sectors.
Exactly. And so many people missed that tech melt up, and now they're wondering if they're going to miss the melt up in cyclicals as well. So discuss that broadening out we've seen in the equity market, please.
Look, the really interesting thing is really since the beginning of June when we had that blowout labor report, right, which came in much better than expected. All of a sudden, you saw a switch in the market. You saw the broadening out into the cyclicals. There was a recession trade there in the stock market, and the recession trade was buy tech, large cap tech, because they can fund themselves. They've got this great new shiny toy. They've got cash flow, and they don't have to borrow money. So that's terrific. And they don't trade on dividend yield because there are no dividends, so it's all fine. And the rest of the market really was terrible, particularly the deep cyclicals, the banks and energy, and the small cap. And what you saw in June was a switch. And all of a sudden you see it broadening out. And now you've got, a greater percentage of the S&P trading above the 50-day moving average. You've healed the market technically in many ways. And so there are other ways to make money. I just look at the industrial reporting from yesterday. How do you have industrials beating estimates in a recession?
Well, but this raises a question that Max Kettner was talking about, as well as Francis Donald. There is a question about whether people are buying into disinflation prematurely and whether the underbelly of this immaculate disinflation is sticky inflation and stagflation down the line. How much is that a preeminent concern of yours?
So it is a concern. I think the world we're in is a higher inflationary world. The thought that the Fed can get to 2% and stick that without a downturn seems difficult because if you just look at what's going on in the labor market, that seems to be the sticking point. We think inflation remains slightly higher through the next cycle. And the question is, does the Fed accept victory at 3%? That's the big question. That's the difference between good probability of a soft landing versus we're going into something really breaking. Is that 2 versus 3%? And does the Fed lose credibility if it accepts 3%?
As an asset allocator in that kind of world, are stocks better than bonds?
Interesting question. So we are more allocated to stocks than bonds right now, but we also have increased our allocation to alternatives, particularly as we're disintermediating the banks from certain types of lending. So we really try to go across all the asset classes to take advantage of the world we're in. We think the world we're in ends with higher Fed funds rate than from before. The thought that we go back to zero is a pipe dream. I think the excesses from that period are clear to all central bankers here. So absent a major crisis, we're not going back to zero. 3 to 3.5 feels like the right number on Fed funds, and that's just a very different world and a very different way to allocate as well.
What's the Levine rationalization of owning, holding, acquiring the successful tech stocks right now? Do you rationalize and move out your terminal rate where you say, I'm buying out 3 years, 5 years? What's the process you have to keep those stocks in a portfolio?
So we don't trade, and the rationale is always the long term. So
yeah, but long term, come on this show, the long term 6 months. Continue.
True. End of year. 3 to 5 years is the way you buy these. You buy these because there is an acceleration of growth in a new business model that will be monetized going forward. Yields will be lower on all likelihood 2 years from now. Then you get the multiple taken care of. You don't worry about a cap on multiples, and that's how you buy them here. That there's a massive growth opportunity ahead of them. The AI creators and the beneficiaries seem to be centered in large cap tech, and that's where you have to go to take advantage of it.
People find this so hard. Shut your eyes, hold your nose, and buy something that's already up 100% this year. Alicia, what do you tell them?
I'd say look at 1995. That's how you do it. Right. I mean, that was one of the greatest explosions of wealth in the stock market, and it was a great time to be picking stocks. But that's really what you have to look at. This is not going to be a short-term story. I mean, of course, there's going to be drawdowns. We haven't had a drawdown this year more than 8%. In the midst of, the Fed breaking some regional banks,
it's amazing.
We sold off 8%. The average is 15%, their average drawdown for the year. So would we like to see that? Of course we'd like to see that so we can, buy more. But... So it's been a really unusual year, and I think the thought of positioning and everybody on one side of the trade is a great reminder when everybody agrees we have to be really careful.
Alicia Levine of BNY Mellon. Alicia, thank you. Heading up wealth management over there, TK, some important lessons, market history of the last 25 years.
What's the lesson in the weekend on the rationalization of bonds and to be bears rather, and to be fair, the rationalization of bulls here? And there's just we laugh about it with Lisa, the toxic brew. It is a toxic brew of emotion over what was missed since October of last year.
And I'm with you, Tom. I can't get out 2-3 years. Can't get out 6 months. Can't get out 24 hours. Chairman Powell, just around the corner from New York. Welcome to the program. If you are just tuning, you're S&P 500. If you are just tuning in, we are negative by 0.2%. Coming up in about 28 minutes' time, the brilliant Ethan Harris of Bank of America on the Federal Reserve, Tom, the ECB on Thursday, and the Bank of Japan to close out the week.
Well, it's important. The three central banks here, and of course, Dr. Harris, iconic across modern economics. I believe he's going to enjoy a retirement, probably writing a new book and thinking maybe he'll fish out of Jackson Hole. He and Brammo can go out canoeing across the lake or whatever.
Brammo went canoeing last summer.
She did.
Yeah, I know.
God, you guys didn't even venture out of the cafe.
Invited me to come. I was like, I'm not going anywhere with those bears.
My goodness.
That is not happening.
I said, do they have floaties? And she said, Tom, they don't have floaties. And I said,
do you use floaties to swim?
No, but canoes. I hate canoes and kayaks. I don't swim. Can you see me swimming?
No, I don't know, Tom.
Can you see? Come on. Can you see me off 3 islands?
You don't swim.
Can you see me off?
Can you not swim?
No. Can you see me off 3 islands in Italy in a Speedo? It's not going to work. I mean, John, don't go there.
Hey, I don't wear a Speedo.
It's breakfast time.
Although I did notice that more and more people at the beach are wearing
Europe.
Speedos.
In Europe.
No, these people were from Australia.
Okay, but they're not American. I've not seen Speedos.
Australia.
Saw that.
Ever since
I don't know if they thought
1950.
that other Italians were doing that, but I don't know what.
We covered it all.
I've got thoughts on that.
I liked it. Australians are from Europe. I learned something today.
Australians. Yeah, there were. I'm telling you.
Did you go up and ask them?
I didn't talk to them about it. I just heard the accent. I was like, oh.
The good news is there's not going to be a recession this year. The bad news is it's still coming. And I think we're in for a big productivity ride once we get through this next downturn. If I had to put potential growth 10 years from now, I'd probably put it closer to 3 than 2.5.
Good morning, everyone. It is Fed Day right now. A lot of news flow going on. That was my interview of the week, no question about it, with a banner headline off Drew T. Mattis, MetLife Investment, where he's looking at a 3% GDP model out. Shocking optimism from a measured and conservative and very competent strategist as well. We're going to get to this in a moment. Here, stag in front of you. Ethan Harris will join us from Bank of America. And, of course, we're getting ready for the Fed Decides. And today, after the Fed Decides, Bramo off Norway is yet to see Barbie. I've seen it twice. And so we're going to go a third time because Mattel's lighting it up if anybody will stay around long enough to get a paycheck.
So basically the news just dropping, Dow Jones reporting that the Gap has hired the Mattel executive who revived Barbie to be the new Gap CEO. You're seeing Gap shares popping in pre-market trading up almost 6% as they do make this acquisition. What is the Barbie trend going to say about the Gap style? I'm just curious. I'm just going to throw that out there.
That was the first thought I had was, okay, how does he Barbie-ize Gap?
Barbie-ize.
You know, beige is really big here. I mean, that's Gap, right?
Well, right. So how do you go back to basics, or do you come with some sort of style? Richard Dixon, the Mattel president and COO, is going to head over to the Gap to be the next chief executive officer. This comes after a year-long search for a new leader. Tom, I thought this was interesting given what we've been talking about with, what was it called again? The sort of movie cycle, but Barbie was like the top.
Yeah, well, you missed all that.
I know.
It's not. What's interesting is we're not over Barbie, and no pun intended, and maybe it's an HR violation, but does Barbie have legs? And I mean, that's seriously the emotion this morning. Ginormous weekend. Shh. Thank you. It's a Zildjian symbol. But it's an enormous weekend. Okay, great. Why does this thing not? I just think they keep doing it. People are. I remember years ago. This is pre-VCR. You went to Mary Poppins 10 times. You went to Sound of Music, 8 times. Why are people not going to go to Barbie 5 times? I would suggest possible.
How many times have you seen it?
Twice already.
All right.
Yeah, it's good. I like Beach Ken. That's sort of the best part of the movie.
That's the vibe you're going for?
Yeah, I went with the beige suit today into Fed Day, and we'll do that. We'll get back on the tracks here right now, if we can, with futures at -8. Yield market, I'm going to call some stasis. Perfect time to talk to Ira Jersey about this Fed meeting and about yields out. Chief U.S. interest rate strategist, Bloomberg Intelligence. Ira, on a cut to the chase, Drew Mattis stopped the show by modeling out a more optimistic real GDP framework. If yields come up into some form of American exceptionalism, American enthusiasm, there seems to be a consensus view we're all going to die. Do we survive a higher real yield? Do we survive measurably higher nominal yields?
So you asked 2 different questions there, right? Because you asked about nominal yields and real yields, which are going to be 2 distinct items, I think, going forward. So number one is, I think that can we survive higher real yields? And the answer is, the economy probably can't, right? So I think with 5-year real yields, a little bit below 2% right now, that's suggesting that there is a risk premium built into the market. And once you have a recession, whenever that tends to be, I think it's probably not until later next year. So Drew's 3% real GDP forecast for 2024 is pretty optimistic, I think. But if it does come into fruition, we probably need real yields to be pretty close to where they are, if not even a little higher. So it really depends on, do you think that there's fragilities in the economy that are going to force us into a recession, and therefore the Fed to ease, which is my view, or not? And if we're wrong and say, my friend Drew is right, we wind up with a situation where yields stay where they are. You wind up continuing to have a very inverted yield curve, and we never see a recession.
Ira's just calling Drew my friend because Drew has tickets to the World Cup coming up in a year and a half. Ira's like trying to see, Brazil play Argentina.
You're on this whole insider trading
That's all that's
right?
about.
That's exactly what we're talking about here. Oh, yeah. We've got the full allegiance over there. Ira, I do want to build on what you're saying. You're talking about how you could, if there is this sort of lack of a disinflation or disinflation head fake, you could see yields and real yields go even higher than where we are now. Does the chance of that seem more likely to you based on some of the housing indications and others, the resilience in an economy that supposedly should be battered by rates at the highest levels going back, to 2001?
So it's a real challenge to actually forecast this market and where we're going. And that's been true since the pandemic, really, because we've seen, different shifts to various parts of the economy, everything from the supply chain issues we saw to now extremely tight labor markets that we didn't expect. Look, I fully admit I didn't expect inflation to be as sticky as it has been, primarily, and this is going back to 2021, a couple of years ago, primarily because we didn't expect the labor market to be so tight and for labor to have pricing power. Now, the question is labor going to have pricing power going forward? People aren't going to switch their jobs every year to go get big raises, which is basically what's been happening in a lot of industries. And if that's not the case, then inflation is naturally going to come down to more sustainable levels.
Which is the reason why, and you were talking about how you got it wrong in terms of the stickiness of inflation. A lot of people did, including the Federal Reserve, by the way. It raises a question about whether models are broken. And there's been a real debate over yield curve sort of prophecy and whether it is no longer the tool that it used to be for forecasting. Do you buy that argument?
So all the yield curve this is all it is the market's expectation of where short-term interest rates are going to be in the long term, right? And at some point, the Federal Reserve is going to lower interest rates. There's almost no doubt about that. The question is by how much, how long, how fast will they do it? When will they start? So the idea that the Fed's going to hike one more time and then start to cut in 6 months, maybe that's where the market's got things wrong. But is the 10-year necessarily mispriced? No, because the Federal Reserve might cut more later, right? So there could be an environment where the Fed stays at 5.5% for, say, 18 months because we have sticky inflation, because all of our models are broken and we don't really know what's going on. And then suddenly something breaks, more banks maybe, or maybe over-levered companies start to fail. Once that happens, the Federal Reserve winds up cutting interest rates very aggressively, maybe down to, say, 2%. Well, if you do all that math and you say, okay, what's fair value for the 10-year in that scenario, we're perfectly priced for that. So there's multiple scenarios that the market's pricing, but all we're saying, all the market's saying is rates will be lower 3-4 years from now than they are today.
The vanilla spread is a difference in yield between the 2-year yield and the 10-year yield. We quote it, and I would say, what do you think, 8% of our audience gets it? The rest are like, what the hell is he talking about?
It's generous.
You're the pro. Which of 45 spreads out there matters to Ira Jersey? 2s, 10s, 3 months, 30 years, the 2-5 belly of the curve, way out in the curve, 10s, 30s dynamics. Which spread matters to Ira Jersey?
Yeah, so the two that I look at is the 2s, 10s curve, and primarily because that has tended to be where markets tend to be the most liquid and where you get the best indication of what the market's really thinking for future economic activity and inflation dynamics. But also for me, for the real economy, one of the spreads that I look at quite a lot, and this has kind of broken this cycle, and it never has before in any other cycle since World War II, is the Fed funds 5-year spread. And the reason is that tends to show where bank net interest margins are and creates the willingness for banks to lend short, right? So basically take in deposits and then lend in 5 years, right? For auto loans or the average of some real estate loans and the like. And if banks aren't making money from making those loans, that's going to contract.
What's the duration of the Fed funds? I mean, I get 3 months, I get T-bill.
It's basically zero. So
Fed funds is like tomorrow.
Right, correct. And
so there's a spread from tomorrow out to 5 years or whatever.
Correct, that's right.
Every time he's on, I learn something. I mean, Bramwell's like snoozing Tom, you dummy. You should know this stuff.
No, this is all important, and honestly, the bond dynamics are going to rule so much of the next cycle, or they were supposed to anyway, when this was an economy that was interest rate sensitive.
Ira Jersey with us from Bloomberg Intelligence. Much coming up, much to talk about here on a Fed Day. We're with you this afternoon. Good morning. Bloomberg Surveillance. Good morning, everyone. Fed decides. We'll be here this afternoon, 1:30. We start. It's like baseball, football, whatever. We start a half hour early. Well, I think he's been pitching well. I like the way he's been seeing the ball. We do that kind of thing for 30 minutes.
We like the walk. We saw him walking into the meeting, and he just seemed to have real confidence.
He's just standing tall.
Yeah,
Bill Dudley will be with us. Bill Dudley, New York Fed president. And it's good to have Dr. Dudley with us of Berkeley and Goldman Sachs and all that, Lisa, because Dr. Dudley really makes a case for vigilance about inflation.
And that's what we've been hearing today as well from people who are in the market, that now the concern is not recession. The concern is stagflation. The concern is no landing, although slow growth and inflation that remains high.
We'll be here, and I get it. It's a quiet meeting. We've already decided this. There's no dots to display. Michael McKee will be in the press conference, but I usually my radar's up, folks, because the quiet meetings can be the more silent surprises that come along in a given statement as well. Futures -8, Dow futures -67. This is a joy, and I'm going to cut to the chase of what Ethan Harris really did. There was a small shop that went under. It was called Lehman Brothers, and he was one of a select few that provided immense stability to Lehman Brothers and the debris. After that, he migrated over to Bank of America Merrill Lynch, where he's been a force for decades, and he's retiring here. I'm going to cut to the chase. Is Moynihan aware of this? Because Brian comes on Bloomberg. Well, I really think real GDP is going to do this, and he's looking down at Ethan Harris and stuff. Did Moynihan allow this?
Yeah, he's allowing it. One of the great things about our CEO is that he does read our stuff, and he really cares about his research department. So I'm going to miss that. I mean, one of the great things about working at B of A is that the firm really cares about research.
I've been busting. He's selling this like, it's just great. Brian, you can't come out in front of the camera. Stay over there, Brian. What's important here is you wrote a magnificent book years ago, Ben Bernanke's Fed, that was a piercing book with your experience at the Fed about the dynamics of the Fed. What does Jerome Powell's Fed look like as you go to write your next book?
Yeah, so I am going to finally write that next book you've been asking me about for 15 years. I think what we're going to see is a turning back the clock. I think the experiment that the Fed did with this 2020 new framework didn't work. And we're going to see a turning back of the clock to something that looks more like a Ben Bernanke or a Janet Yellen Fed. I don't think it makes sense for the Fed to do what they did, which is wait to the last second, wait for inflation to be really underway, and then start to hike interest rates. So I don't expect radical change, but rather kind of just go back to the old model.
Well, the old model, is it the old model meaning 10 years ago, or is it the old model 40 years ago, which was very different? And that's really the big debate we've been hearing about. What's your view of how we're going to look back at this moment in history? Was it a sea change that ushered in a new era of high inflation, or was it a pandemic-induced blip that's going to go back to what we were seeing 5 years ago?
Well, I think the Fed has demonstrated that they learned a lesson here. They started very late, and you'll hear that from Bill Dudley later today. He was one of the people arguing they should get moving. And they started too late, and then they did an incredibly aggressive catching up. And that was a signal to me that they understood that they'd made a mistake. Because you don't want to be going 75 basis points a meeting. It's very dangerous normally. But if you're way behind the curve, you catch up. So I don't agree with people who say they're going to compromise on their inflation target. At his press conference, he repeats over and over and over again. Every chance he gets, he says, we're serious about hitting our 2% inflation target. He's putting his credibility on the line. He does not want to be Arthur Burns. He wants to be Paul Volcker.
What have we learned, though, about this aggressive tightening? You're saying they don't want to do that. They did that. Nothing broke. You could argue, okay, we saw some bank rumbles, but right now we're looking at housing reaccelerating, seeming to have already bottomed, and much of the economy performing better than expected. What do you make of that?
Well, I think that they were up against some very big tailwinds in the economy. You had all that massive excess saving left over from the fiscal stimulus during the crisis. You've had pent-up demand for workers with all these job openings. And so the Fed did achieve some weakening in parts of the economy that are interest sensitive, but the consumer just refused to roll over. Jobs were great, the savings were high, and they could spend their savings. So I think it's delayed the weakness, and we still think a mild recession, probably early next year. But like a lot of other forecasters, we've been forced to concede that it's not here. It's going to take a while. I don't think it's the end of the world. There's this hard landing, soft landing debate. Come on, if you're forecasting the unemployment rate going from 3.5 to 4.5, that's not a hard landing. That's great. That's normal unemployment. Yeah. So it's the people I disagree with are the perfect landing crowd that says, oh, you don't have to have any pain at all, that inflation's going to go away on its own, no adjustment in the economy. That I disagree with. But it's going to be a soft landing, either bumpy or a little more bumpy, but it's not going to be a hard landing.
With our new data capture, with all the noise that's out there, is there too much communication? We opened the show with a beautiful vignette one of our interns put together of all these Fed speakers speaking. Is there too much communication?
Well, I mean, that's the structure of the Fed, right? It's a very...
Not the old Fed.
Well, when Greenspan dominated, he suppressed the rest of the committee's openness. And so that's changed under the new Fed chairs. So there's a lot of information coming out. I think the business reporters are a bit too hyped up about this whole thing. They keep talking about hawks and doves and all that.
Hawkish pause.
Yeah. Well, look at the Fed. There's been virtually no dissents through a period of way behind the curve, fastest tightening in history, and now data dependent. Nobody's dissenting.
Right.
So the idea that you need to get all pumped up about what some dove said or what some hawk said, I think is way overdone.
You have been prodigious in building careers. I mean, what you did for Michelle Myers, she went off to some charge card company to, I don't know what she was thinking. Moynihan's, you have to recover from Michelle Myers leaving. But the bottom line is you've built careers. You came out of the Newtonian calculus at Clark University up in Massachusetts. The idea here of math that matters. Is there too much math now in the game?
Well, not in the part of the area I'm in, right? If you're a Fed economist or a street economist and you're trying to figure out the economy and policy, we all understand that it's a lot of storytelling and historic analogy that you don't want to get too crazy about the modeling. Yeah. In academia, has been this drift into mathiness where you impress people by the complexity of the model. Yeah. But it doesn't really work in the real world. So there's become a split in the economics profession between people who are practical economists and the ones that do the mathiness.
We're speaking with Ethan Harris of Bank of America Securities after more than a decade at Bank of America, who is retiring as of this Friday, I believe. I believe this is your last interview that has been scheduled, and we appreciate you sharing it with us. I want to pivot a little bit because we're talking about looking back over a trajectory of a career and understanding where we are at this moment. Do you think that in the future, people coming into this industry will be working in an office to the same degree? Do you think that will be one of the big sea changes that persists over the next decades?
Well, I think to some degree, hybrid is the new normal. I think there's a battle going on between corporate leadership and the staff about whether that's really what they want to do.
Harris getting himself into trouble. He's on the 2-day countdown, and HR's compliance is like, what's he saying?
Yeah, so maybe today is my last day. But no, I'm not talking about Bank of America. I'm talking about in general, and there's a trade-off, right? So it's definitely not good for developing new people to have everyone sitting in their pajamas at home. That's not a good
May we quote you on that?
Yeah, exactly. If they don't have their pajamas on, then you're really in trouble. But anyways, so you don't want to be entirely at home. On the other hand, in my case, I have a crazy New York City suburb commute. And so for me, I'm more productive if I'm working hybrid. So that's really the debate. It's about, what's the most productive model? And I think in many industries, hybrid is going to end up being the thing.
A sensitive question as we talk about some of the earnings of tech companies and artificial intelligence. Is ChatGPT going to be your new research assistant?
I tried it. And in fact, a friend of my son tried it out, and he put my name in there and started asking questions about me. Now, I've got a lot of visibility in the press and stuff. What I found with the chat app is that at first it gave very good answers. It found my my bio and wrote it up in better language than I did. But then as my son's friend kept asking tougher questions, it started returning nonsense. It started telling me that I'd won some great prize in Japan for
Maybe
some, yeah, there's some like, it's like a peace prize or something in Japan. And so if you pushed it and tried to get it to get really interesting, it gave you junk.
I've got to ask you this because it's the heritage. Can you give all of our Global Wall Street audience a vignette of what it was like, not the final days of Lehman, but a week after Lehman, a month after Lehman? Give us a window and how you and others had the leadership there to pick up the pieces.
Well, I mean, everyone was in shell shock, and I was lucky. My team got picked up by Barclays, and so we had a life raft, lifeboat to jump into. But you were kind of in this environment where you had both these forced marriages going on in Wall Street, which are never fun, at the same time that you have this incredibly demanding and interesting and challenging world you're trying to forecast, where the economy is just collapsing. And it was an amazing time, and you just had to kind of, lean on each other a bit, I guess.
Ethan Harris, thank you so much with a huge commitment to the show. It's just been great.
Thank you so much for being with us. We really appreciate it.
It's been great. I hope it's not my last time on.
Can you give this box here? Can you come on over? Give this to Brian. Okay, he's tearing up over behind the camera.
You guys are really trying to get me into trouble.
Brian, contain it. Okay, he'll still talk to you. It's amazing, and we bust people's chops, Lisa, about this, and we can talk about this. I mean, these CEOs come out and they're under the gun. And some are informed and some are not. Mr. Moynihan, always informed. We're going to inform Brian Moynihan right now. Standard & Poor's 500 down 0.2%.
If you're just joining the program now, coming up, we will be speaking with Sean O'Brien, General President of the International Brotherhood of Teamsters. And Tom, this to me comes at a real tension point where people don't understand the dynamic in the labor market. Labor has gotten an upper hand in a way that they haven't had for decades. And this comes as it's a victory for certainly the Teamsters, UPS to some degree, and also Joe Biden.
This could be a one-hour conversation. It comes off of John Farrell's great work with Marty Walsh, as well as Secretary of Labor, former mayor of Boston. But it's dragging a truly American institution, the Teamsters, with all of the debates. We don't need to get into that with Mr. O'Brien, forward into the modern age and the symbolism of this UPS deal. And I'm sure he'll sell us on what's beyond it. But it's a huge moment for organized labor going well past the 1930s.
Yeah, and some 340,000 members. This is not an insignificant thing. I'm curious about the details because, yes, you do have the Teamsters saying that UPS blinked. When you have this kind of messaging, you do wonder what the actual concessions were on all sides. I think something like $30 billion extra given to the members. What is the new paradigm for labor negotiations?
Well, the new paradigm here, and the question is, does labor finally get a share? I mean, Ethan Harris, Lehman and Barclays and on the Bank of America can remember when labor had some form of power, and they gave that up for whatever events off of 2007, 2008.
And corporate profits as a share of the overall pool increased. Do we see a reversion of that, or is this just a very small adjustment at a time of distortion?
We're going to continue. It is Fed Day, but coming up, this important interview with the head of Teamsters from Local 25 in Boston to changing the labor economy of America, Sean O'Brien. We'll do that next. Stay with us. This is Bloomberg Surveillance.
A fair contract is one that the members are going to ratify. So a fair contract is something that that workers choose at the end of the day. And again, that process is important for the parties to be able to negotiate, to be able to stay at the bargaining table, and to be able to resolve issues. That we want stable work. We want a path to the middle class. We want security in retirement. We want health benefits. We want leave. Those are all things that the president has prioritized. And I think those are all elements of what it means to have a good job.
30 days ago, the acting Secretary of Labor, Julie Su, there on a jobs report and talking about labor in America. We're going to get to that in a moment. With Sean O'Brien, who is the General President of the International Brotherhood in Teamsters. We've got a Fed meeting coming up here this afternoon. We're watching the markets as well. We're going to get some movers done here as well. You want to do movers now or later?
I think this is too important.
Yeah, I think this is too important. We're going to do movers later, even though we're in the heart of earnings season. We could go for an hour, frankly, on this. This is the conversation of the day. If you are in Local 25 in Boston and you grew up with 3 generations of Teamsters, and then you take on all of what we know, all of the decades and decades of history of the Teamsters, and you revolutionize unions in America, you come to a moment like we saw yesterday with Big Brown UPS. Sean O'Brien has provided the leadership on this. He's General President of the International Brotherhood of Teamsters and joins us this morning. Sean, congratulations on this pre-vote agreement, this handshake agreement you have with UPS. In your comments and others, you say Amazon is next. Where do you move from this successful agreement to the next transportation company? Is it Amazon? Well, we've got some audio problems there with Sean O'Brien. We'll come back here in a moment. Lisa, I think this is just so important, and my sophisticated observation is driving north on 3rd Avenue at any given time of day, where the trucks of the Teamsters are lined up on 3rd Avenues delivering all those boxes to our building.
When you talk about Amazon, are they the next one? I'll give you some sense of the details of this agreement. There was a wage increase. Existing full and part-time UPS Teamsters will get $2.75 more per hour this year, and $7.50 over the tenor of this contract that goes to 2028. So if you think about where we are in terms of the wage increases, what is the new minimum wage? Not dictated by the government, but dictated by workers who are needed more than ever on the front lines of some of these roles.
And out of the railway strike, there were things in here that I thought were almost commonsensical, like a discussion of what to do with Martin Luther King Day, MLK Day in January, where the Teamsters get the rest with everyone else, including us, to things that you can really see are within negotiation of the defining of part-time and full-time workers in the 7 shades of gray. I'm making that up, folks, the 7 shades of gray between that. This was heated debate.
And it also comes at a time where people are wondering how much longer the labor power can really continue. Just some more details. I'm working through some of the details, and it really highlights how differently we can look at some of these roles. UPS delivery drivers, just to give you a sense of how much they're paid per hour, $49. That is the top rate, $49 per hour. That is the highest paid delivery truck drivers among all of the ones in the United States. Does this set a new low mark for all of the other companies? To your point about what does this say for Amazon, that's been also raising wages
what's so
to keep
important
up.
here, and we've had some technical difficulties with Mr. O'Brien. We're trying to pick that up again. We'll see if we do that. Perhaps Bloomberg will speak to Sean O'Brien here later in the day, and if we can redo that. But Lisa, what I would mention here is the idea of the generational change. There are stereotypes of all these organizations in the government, outside, and someone like Sean O'Brien has blown that up. To just read his Wikipedia, but forget about that. Read the literature on what this kid out of Boston did, and there's a modernity to our union discussion now, and you wonder where that's going to come. We're going to try to pick it up here now with Mr. O'Brien here with not enough time left, but we'll go there. Sean, again, congratulations on this. If I look at UPS and I move forward, is Amazon your next company to speak to?
Amazon is definitely going to be a target to organize. We're going to take this historic agreement and use it as a template to show the Amazon workers what they will receive when they join the Teamsters Union, and we organize them.
The significance of this agreement speaks to a new Teamsters. Does all of America, including, I'm going to call capitalist America, misunderstand the modern labor dynamic?
Well, I'm not sure if they misunderstand it, but the one thing that we were able to achieve with this agreement is that we showed the entire country what you can do when you have the support of your rank and file members. I think we put some more energy into the labor movement, but also we got the largest deal done without having to strike the company. So I think we added credibility to the process, and also, more importantly, we set the tone for what organized labor can achieve against corporate America in these high profits, and we want to be rewarded. Our members need to be rewarded.
Sean, you said that UPS blinked in a statement to your 340,000 members. Do you get the sense that corporations are more willing to blink now because of the labor shortages, that your negotiating power is stronger than it's been in a very long time?
Yeah, I think we've got tremendous leverage right now because we can leverage our ability. We've provided tremendous support during the pandemic, providing goods and services. And I think now it's the time to capitalize. I mean, far too long, we kept seeing CEO pay increasing and stock options increasing, and our members' pay, not just in the Teamsters union, but throughout the labor movement, were not increasing. So I think right now we have the ability to really, really showcase and be the model and encourage other unions to stand up and fight.
How do you decide, Sean, when you're negotiating what the threshold is between workers' rights and workers' pay increases versus the health of a company, of what's sustainable over a longer period of time, given that prices are increasing and this is an inflationary environment?
Well, I think first off, I mean, we had a great situation here with UPS. Because of our members and their hard work, they made $100 billion. So a healthy company should share the profits and should share the wealth. Look, we take every negotiation. We do a deep dive. We're a lot more sophisticated than we were 30 or 40 years ago. So we obviously study the finances, study the projections, and make certain that, we understand what we can get out of these companies. But, far too long, everybody uses the economy saying, hey, we could probably go into a recession. Right. And that's all well and good. We always come out of bad situations at some point in time. So we always just stay focused on what our members need. We're not too concerned about Wall Street or anything else. What is going to help our members survive and provide middle-class opportunities for their families.
Mr. O'Brien, in the time that we have left, I mean, your sons are involved in this. Your father was Local 25 as well. You've lived this for your entire lifetime. How do we change the atomization of labor in America, the deunionization of America? Do you perceive a sea change with this agreement?
Yeah, I think this agreement's going to be a template to show the entire workforce, union and non-union, what you get when you join a union. You're going to get wage increases, you're going to get health and welfare, you're going to get pension, but more importantly, you're going to get dignity and respect and a future. This agreement that we negotiated, we protected against technology. We provided for full-time job opportunities. That's the leverage that you have when you're working for the best contract in the industry, and we achieved that.
Sean, we're just going to run out of time here. I want you to speak to the Bloomberg Surveillance Office. There are a lot of fancy people. Let's be blunt. They're probably less pro-union than many. What do the Teamsters bring to capitalists to provide for better productivity?
Hey, we bring the best workforce in America. We proved that during the pandemic, not just in UPS, but picking up rubbish, delivering groceries. We provided goods and services. We proved we were essential, and we're going to continue that post-pandemic, and we've got the best workforce in America.
Sean O'Brien, congratulations. All I ask is after UPS, you do something about the Red Sox. Sean O'Brien, Local 25 in Boston, and also with the International Brotherhood of Teamsters there as well. I will never forget, Lisa, the study that was done. I'm going to give credit to Mount Sinai. I could be wrong on that, where they partitioned labor in hospitals during COVID. And they got more done with the union labor than the non-union labor, because of the organization structure. That humbled me.
Well, it's a new era, and that's really my question, is how much of the dynamic of a shifting in labor's force, how much is that going to stick? Is it going to stick? It's a huge mystery out there in the weeks to come. We will see. Not in the weeks to come, in the hours to come. The Fed decides this afternoon.